All right, how's it going, everybody? My name is Antonio. I don't have a guest for this week's transition talks because someone canceled on me last minute. Um, Long story short, anyways, no guest. But I do have NexGen's Lee Courier here later on. So I also have a list about of 30 or so questions that I want to ask. All the questions that people are asking online, everything about executive compensation, marketing, everything that I have got it all on my list. So hopefully I'll be able to get to them. And I have two other companies in here as well. One of them is a uranium company. The other one is a titanium company. So I'll just get into the CEO barbecue portion here. But first, there is, as always, is a warning on your screen right now that I will need you to pause the video and read it. This is not just some disclaimer, though it is a disclaimer. It is also an actual warning that you should care about, and this might prevent you from losing money. Because although this channel is here to make money, it's no secret that here at Research Talks, we still try to be different than other channels. And the way we do that is by not hating the viewer. What that means specifically is that I would like you to be aware of the fact that one of the companies that you're going to see in here, and specifically UR Energy, has paid for the production of their interview. The other two companies, so Temas Resources and NexGen, have not paid for the production of their interviews, but still they're likely seeing this their participation in this program. They're probably seeing it as a chance to do some marketing. Okay, so be aware of that. Start by understanding that. And also just be aware of the fact that this and other channels who interview CEOs, talk about companies, present whatever they might be doing, we typically earn money by charging companies for the creation and publication of these interviews, even though most might not be as vocal about it as you might like them to. So although I don't make buy or sell recommendations because I think there's a clear conflict of interest and also because I still have no idea what I'm doing, many will do that. And so you should be aware of that fact. Just want to let you just know that. So anytime you're watching any type of company specific content or whatever it might be relating to stocks, just approach it with a dose of skepticism if it's online. And again, as I always say, maybe even try and use your own brain every now and again. But also, again, although I try to do a decent amount of research, again, I've prepared about 30 questions for NexGen here, and I don't give the companies the questions up front. So there have been negotiations happening with some of these companies. There's also a company, by the way, just this week that I saw in an interview that just a couple of weeks ago asked me to share the questions up front. And I said I don't do that. And then they got on the phone with me. They basically told me I'm stupid and told me I'm not going to do that I'm not going to get the interview. So no, I don't. I don't give the questions up front. No questions are off the table, and the companies get no say in what ends up in the final video. Although all that's true, and I try my best at this, and I don't sign any release forms or anything like that. These things should still be looked at as advertisements. All company related content out there should, and not as research, and least of all as recommendations. None of that is in here. Okay. And just be aware of that fact. There are no guarantees here besides the fact that there will be forward-looking statements made in these conversations. Those are conversations that are general and impersonal in nature, and they are going to contain hopes for the future that may or may not take place depending on many different factors. So be aware of that. Please talk to a professional investment advisor, and please do more research before taking your own decisions in the end, and go to setterplus.ca where you find the official companies findings and stuff like that. Again, the disclaimers on your screen right now. If you don't enjoy losing money, read them and be careful out there. With all that said, though, I am going to start shutting up now. Well, after I give this company overview, because I'm going to be traveling to the US to get an update on an old friend of the channel, actually, with that being Mr. John Cash, the CEO of UR Energy, which is a growing uranium producer. The company is dual listed, with that being URG on the NYCA and as well as URE on the Toronto Stock Exchange. In Canada, where an average of about 120,000 shares trade each day, with a 52-week high of $2.72. That's Canadian, of course, and a 52-week low of 20. Oh no, actually, it's way above that. I was looking at another year, I think, but 20. Anyways, I'll put it up on the screen so people can see it. There's a market cap of currently 683 million Canadian dollars, and about 281 million shares are outstanding. So that makes this at today's prices a $2.42 stock. There are about 20 million warrants and 10 million options and RSUs outstanding, resulting in about 310 million fully diluted shares. Looking at the latest balance sheet, which is dated March 31st, the company had about $60 million in current assets, most of which, that's $54 million of which, to be specific, was in cash and cash equivalents. And there's also about $4.7 million that was in inventory. There's no long-term debt, and the current liability stood at about $5 million, with account payables being the biggest part of that at about $4.8 million. That same financial statement also tells me that on average, over the last reported 3 months, UR Energy recorded a little over $15 million in operating costs for that total period. So that's a little over, well, I guess $5 million a month overall burn, with the split being very heavily weighted towards development. And so $11.5 million went into that. And then there's another $1 million that went into exploration and evaluation, with an average of about $850,000 per month being spent on general and administrative expenses, which in terms of ratios ends up being about 82% of the money going into the ground, going into development and exploration combined. So that's less than 20% being spent on what I would typically call bureaucracy. Same as always, though, dear listener and viewer, I will need you to understand that this is only a snapshot in time, in this case, specifically at the end of March of this year. So please head over to the company's website as well as setterplus.ca to look at all the numbers yourself to make sure you're getting the full picture here. Accounting aside, though, this company needs no introduction. John's been on the channel multiple times. As I mentioned, long friend of the channel, longtime friend of the channel. Done many interviews over time with him. But a quick overview, I suppose, of where UR Energy is today. This is, as I said, a uranium producer. So they are actually producing and selling uranium, and it's a growing uranium producer. They have 2 main projects. They're both in sort of south central Wyoming, is what I'd call them. Both of them ISR projects. So not actually mining in a sense of open pit or underground, they're ISR extraction methods. Lost Creek is the already producing asset. That's the one that's actually putting yellowcake into drums, sending them out, getting money in. And they just got new header houses to operate that ISR production from. That's where a lot of that spend that I told you about is coming from. And so they have produced, that facility has produced 2.8 million pounds of yellowcake through 2023. Still housing over 12 million pounds of U3O8 in a measured and indicated category, and over 6 million pounds in the inferred category, with grades that aren't that high relative to your Athabasca grades, but they're high enough for this extraction method, as the operating cost here is estimated to be at under $17 per pound on a $1.2 million pound production capacity per year for a 13-year mine life as it stands today. But of course, not all of that land up there in Wyoming has been looked at, so there might be exploration potential here, something I will hopefully be able to touch upon later on in the conversation. And then the second project that I mentioned, Shirley Basin, it's a fully permitted ISR facility as well. So it's housing 9 million pounds in the measured and indicated category. That's at 0.23% U3O8 grade, so higher than Lost Creek. And it's got a licensed annual production capacity of 1 million pounds of uranium, with construction estimated to be completed in the second half of next year, so 2025, which is when UR Energy expects to be producing there at under $25 a pound. And that construction decision has now been taken, again, a point of discussion for later on. In addition to these 2 assets, UR Energy also holds a portfolio of, I believe, 3 exploration assets, which, again, I hope we'll be discussing later on as well. But for now, it seems like a good time for me to shut up and let John do the speaking. John, let you come in. Thank you, of course, for being here. How's everything been since we last spoke?
Oh, thank you, Antonio. Really appreciate being back on the channel with you. No, things are going great. It's really busy right now with all the activity you just described. The weather now here in Wyoming, we're moving out of winter and springtime and into summer temperatures. We love that. That helps with our productivity. It's just so much nicer to work outside when it's 80 degrees than when it's 20 below zero. So no, things are looking great. The market's looking really good, and excited to have the conversation here.
Do you do a lot of outside work yourself? As a CEO, I typically imagine you just sit behind the desk and take phone calls all day.
I wish I was able to get out more, quite honestly. They say that sitting is the new smoking, and I sit around way too much and wish I could get out more. And ironically, I was out in the field, out at the mine yesterday all day, so it was good to get boots on the ground.
Nice. Yeah, happy to. And you're also, I mean, your head office, to call it where you're sitting right now, it's just in Wyoming. It's close to the facility, right?
Yeah, so the drive from here, the office in Casper out to Lost Creek, it's a 2 hour drive. Most of our employees that work there work out of Rollins, which is a 1 hour drive.
Hmm.
Shirley Basin is a lot closer to Casper. It's a 1 hour drive, so very close. It's paved road almost all the way to Shirley Basin.
Hmm.
So a much easier drive than Lost Creek.
Mostly ranches in the middle, or like what's happening in the middle
Oh
there?
yeah, wide open spaces going to both. Our nearest landowner to Lost Creek, our nearest home to Lost Creek is probably about 15 miles away.
Okay.
And for Shirley Basin, our nearest landowner, we have a local rancher there who's a great ally to the project. The ranch house is about 3 miles away. And then the next nearest home from there would be probably, again, about 15 to 16 miles away. So,
Hmm.
yeah, they're remote sites, which is great for a uranium mine. We've got very strong local support from the ranchers, good support from the community as well. So that makes it a lot easier working here in Wyoming, where it's a resource recovery state: coal, oil and gas, uranium, bentonite. And so it's a really strong regulatory regime, and natural resources are understood by the public.
And it's also ISR, as I mentioned. So essentially, your mine site is just like holes in the ground that are like cased. Basically, when you look at it, it doesn't look like a mine site.
Right. Yeah. No, it looks like a field that's got grass in it.
Hmm.
But every 100 feet on a grid, there's a wellhead, and the wellhead looks like a beehive. It's a brown, Carlsbad Canyon
Hmm.
brown box that sits on it. And then every few acres, there's a brown header house where the water is collected. So now the wildlife, while we're mining, the wildlife, the antelope, the sage grouse, they continue to utilize that space. So it's a very light footprint. And one of the beautiful things about it is when we're done, we'll reclaim the surface, and it's free release. Within a few years, you won't even be able to tell that we were there.
Hmm. What kind of wildlife? You mentioned the antelope. Um, and what else do you get?
Antelope,
Business, I guess.
antelope would be the most common large game animal. There are a few wild horses in the region
Hmm.
that were brought over by the Spanish many years ago. Sage grouse, not a lot of wildlife out there. A few foxes, a few coyotes, things of that nature. But it's high plains desert. We actually don't have snakes because it's too high elevation and too cold. But yeah, wintertime, it's not uncommon to get 20 below Fahrenheit for days or weeks on end, with wind to go along with it. So that really limits the wildlife and the diversity out there. And we only get about a third of a meter of rain a year, 14 inches or so of rain on a good year. Some years we only get maybe 8 inches of rain out there. So it's very dry, high plains desert.
Okay. Bisons, black bears, I assume, coyotes, stuff like that.
No bison.
Oh,
Regionally, there are some black bear, but we typically don't see those at the mine site.
yeah.
There are
Okay.
no trees.
It has very little to do with production. I'm sorry, I just got interested there
No,
for a
that's
second.
okay.
You did have a production update for Q1 of this year since we last spoke. A couple of things really to go through. But what was your initial thought when you saw this production update? Did you expect it to go like this? What is your how do you see it?
Oh yeah, no, we keep up very closely with production and what's going on. Our chief operating officer, his office is just a few doors down from here, and I speak to him every day. So we've got good tabs on what's going on at the mine site, even though I'm not out there as much as I would like to. So yeah, no surprise there. We do want the numbers to be higher. We are still ramping up into commercial production, and we have a ways to go there. We're packaging a lot more now, more routinely, and our head grade remains very strong. But we just need to continue to bring on header houses. We're projecting this year to produce around 600,000 pounds. We're maintaining that estimate.
Hmm.
We're nearly halfway through the year, so we're going to maintain that estimate for now. And we'll just keep going, keep training our guys, and keep ramping up into commercial production. Our contract book for this year, for 2024, is 570,000 pounds. We've already been filling, making deliveries into those contracts, and we've had some revenue, not a lot yet this year, but we've had some revenue from that. So yeah, well, it's just a matter of continuing to push and ramp up.
Hmm. What's holding you back, so to say, as in Like if you had a magic stick, what would you change to bring you to that? What is it, $1.2 million pound capacity that I
Yeah.
said?
Oh, that's easy. Manpower. We've got our manpower, but our manpower is inexperienced. Now that is changing, and that's why production is improving, is because our guys in the field, they understand things better. They know how to operate efficiently. But yeah, if I could change one thing, we have excellent staff, but I would take all of them, wave my magic wand, and give them 10 years of experience.
Hmm.
That would be a major game changer for us. But that's coming. It just takes time. We have a lot of experienced guys in senior management and middle management. So it's just a matter of us taking our years of experience and that knowledge we've gained, all of the mistakes we've made over the years, and teaching our younger, less experienced guys, hey, don't do this, do it this way, work safely. And so we're doing that on a day-by-day basis.
All right. How many people do you have working for you now?
75 company wide, about 65 people out at the mine site. That doesn't include our contractors. Right now, we've got 13 drill rigs. Each of the drill rigs has a three-man staff, so 39 there, and we're looking to continue to grow the number of drill rigs considerably going forward, especially as we move not only production at Lost Creek, but we'll need rigs, additional rigs out at Shirley Basin. Ultimately, at Shirley, we probably need about 5 drill rigs there to keep up with production, 1,000,000 pounds a year. Lost Creek, we need about 12 or 13 minimum to keep
Hmm.
up with production. It's where we are right now.
Hmm.
We need more rigs at Lost Creek because the ore is a little bit deeper. It's about 450 feet deep. Shirley Basin, it's about 300 to 350. But also, Lost Creek requires a much more delineation drilling because it has had less historic drilling. Shirley Basin, there's tremendous historic drilling. So we don't have to do much delineation there, or very little to none. We can go straight into production installation of injection and production wells. So some significant differences between the two properties.
Yeah. And just to clarify also for people listening, when you say drills, those are drills that are drilling wells. Those are not exploration drills. Just want to
Right.
throw it out there because we talk mostly exploration actually on the channel. And there are mostly exploration companies in the uranium space. You're one of the few producers. So that's why I'm
Yeah.
clarifying. You also had some inventories. So your inventories were almost 80,000 pounds of U3O8 at the end of that quarter. Um, Given a strong market, prices are up. What's the strategy? What's the plan for this inventory?
Yeah. So for the inventory, our objective this year is really to fill contracts. And any production above and beyond the contract book, which again is 570,000 pounds this year, we'll put it in inventory and start growing that inventory to fill contracts going into next year. I don't really see that we'll sell into the spot market in the near term. Maybe 18 months, 2 years out, if we have excess production, we'll sell that in the spot market if the spot market's hot, but that's not a priority for us. The spot market is pretty thinly traded. If we start dumping a lot of production pounds into the spot market, I think we probably would suppress it pretty quickly. As a company, our strategy has always been historically and going forward, our strategy is to sign good, high-priced, long-term contracts with utilities, other fuel buyers to sell into that. That gives us stable revenues. And if the market goes down, those revenues are locked in. If the spot market goes up, I can go down the hall, talk to my chief operating officer and say, kick it in the pants. Let's produce some more pounds. Let's produce above our contract book and we can sell into the spot. But until we get ramped up and get commercial levels at Lost Creek and at Shirley Basin, that's simply not in the cards. We're focused right now on filling contracts.
I definitely want to touch upon your approach to contracting as a whole as well. But also don't assume, feel free to talk to me about that, but I don't assume you have plans to be buying in the spot market either, right?
No, we don't have plans to buy in the spot market.
Okay.
We're a producer. We'll produce those pounds we sell.
I like that, and I agree with that approach. Average production cost is also was higher than what you thought it would be, I think, because it was $28 a pound, I believe. Do you expect that? Well, I assume you expect it to start coming down soon, but when and how do you see it coming down?
Oh yeah, no, absolutely. So one of the things that we don't talk about a lot in the industry, but is critically important, is economies of scale. And to get to those economies of scale where we really drive down our cost of production, we need to be up there minimum of 500, 600,000 pounds a year of production. Once we reach that threshold, that dramatically drives down the cost on a per pound basis. And we released revised tech reports not so very long ago with our annual report in the spring of this year that's got our production estimates on cost. And we believe we can get down to those. For Lost Creek, we believe we can get down below cash cost of $17 a pound. We're going to be a little higher than that at Shirley Basin. But yeah, economies of scale are absolutely critical, not only to us, but to any miner, whether that's copper or gold. You need to produce as many ounces or pounds as you possibly can. And the reason is you've got so many fixed costs. For example, at our Lost Creek mine, we have a monitor well system. We have to monitor that. We have to hire staff and monitor that, whether we produce 1 pound a year or whether we produce 1,000,000 pounds a year. So obviously you want to produce as much as you can so you can divide that cost into as many pounds as you possibly can to drive down the cost. That's just one example. I could give you dozens of examples where the cost is there, whether you produce 1 pound or 1,000,000 pounds a year. So those economies of scale are critical to us, and we do expect those to come down significantly as we continue to ramp up production.
So by the time you're producing it at Shirley Basin, hopefully towards the second half of next year, where are you in terms of production costs? What's your projection?
So at Shirley, we're going to be looking at around $24, $25 a pound. Lost Creek, we're looking at around $17 a pound. Now, those are cash costs. There'll be additional cost above that, but the actual cash burn that we need to put in a per pound basis, that's what those numbers would reflect.
Yeah, well, that's the official. I think those are the numbers that you had in your official studies before you started going into production. What I'm asking here really is, are those realistic? Like, do you expect to have them in 2026 already be producing at those prices?
Oh, yes. I would expect to have them in 2025 at Lost Creek. Shirley Basin is going to take a little longer. Obviously, it doesn't come online until late 2025, perhaps early 26. So it'll take us maybe 6 months, maybe 12 months to ramp up into commercial production. So the cost there at Shirley, we would expect them to be higher for the first 6 months, 12 months. It's hard to say exactly how long, but by 2027, we would expect those costs to have plummeted significantly as we ramp up and we get to those economies of scale.
So, okay, yeah. So by the end of 2026, if I were to paint a picture, you're producing 2.2 million pounds of U3O8, and your average price is somewhere between the two projects. It's somewhere between 20 and say $23.
Right. Yeah.
Okay. Yeah. That sounds like a fair picture to you?
Yeah, it does. When you look at the cash cost, absolutely.
Yeah, cash cost. And then what you're adding to it is if there's some financing cost to it, and then G&A you're adding to it. How much are you thinking for G&A, by the way? As the company grows, I assume G&A is also going to grow. As I said, last quarter, you spent about $850 a month, call it 9, rounded up to $10 million a year. Is that where it stays during production, or does it go up?
Yeah, no, it should stay about that. The additional cost we would see at the mine site would be any financing, capital expenditures, things like that. So at Lost Creek, you're probably, when you do an all-in cash basis, you're probably looking around $35, $36 a pound, a little bit higher than that at Shirley Basin because it's a smaller project. So you have to divide those pounds or the cost against fewer pounds. So on an all-in basis, when you look at the spot market of $90 a pound, we're dramatically less than the spot market on our cost. And also when you look at our contract book, we're well in the money on our contract book. And we've put out a little bit of information on our contract book and on the pricing there. This year, for 2024, we're going to be very roughly around $60 a pound on our contracts for the two contracts we have this year. Going into next year, that contract book just continues to ramp up and up and up. We'll get up to a maximum of about 1.2 million pounds per year here in a few years in our contract book. If you look at the next 6 years, the 6 contracts we've signed up so far, divide those pounds out, it really is only just over 50% of our production capacity. So going forward, we've got a lot more room, production room, that we can sell into long-term contracts. Or if we wanted to sell into the spot, although that's really not our objective, it's not our strategy. So we've got a lot of room left, though, of production that we can contract out. We're being pretty patient right now. The market's pretty strong. The long-term price is about 80, short-term spots around 90. So we're being patient right now. We believe the market's got some more room to move. And I'm sure we'll talk a little bit about geopolitics. I won't jump into that quite yet, but we think there's some other shoes to drop there. So we're not just chasing contracts right now. We're being pretty patient.
There's you're projecting $33 million in revenue for this year,
Right.
570,000 pounds sold, $58 a pound, something along those lines is what that comes down to.
Yeah, that's right.
Okay. What is that money gonna go into then? And again, I'm not ignoring what you just said about contracting. I'll come up to it. But what is that 33 million bucks gonna be used for? Just developing Shirley Basin and that's it?
Yeah, for this next 18 months or so, yeah, we're going to be putting money in the ground at Shirley Basin to get that facility built out. So yeah, I would say our revenues are headed that direction. You did indicate earlier on in the opening our cash position. Our last report, we had a little over 50 million in cash, no debt. So we're using that and revenues to continue to ramp up Lost Creek, build out Shirley Basin, get it up and running and get it into commercial production. So that's really where we're going to dedicate most of that revenue.
Okay, so 50 in cash, 33 in revenue, subtract G&A from that. That puts you, so that's 83. So that's going to put you at 75 million bucks left to develop Shirley Basin. Very rough numbers here. So is that going to be enough to get you into production?
Yeah, that is. I mean, we've got other costs on top of that, but a little bit of capital expenditure at Lost Creek potentially with the wastewater management system. So we've been talking about that in our disclosures. So perhaps 19, $20 million there. But yeah, that should be pretty much enough to get us through the build out of Shirley. We'll see where it puts us into ramp up. But as far as going out and doing an equity raise for Lost Creek, or for Shirley Basin to ramp it up, it's not in the cards right now. I think we're in a very good, strong position to see us through on those two properties going forward.
Also not chasing any type of outside financing, or be it debt or project level dilution or anything like that.
No, we're not looking for anything right now. We will be creative. We've been very creative in the past to minimize dilution to our shareholders. I'm really proud of that. I think our performance in that regard is probably we set the standard in the industry. But if we do go out and do any type of a fundraising event here in the next 2 years, we'd prefer it be something creative, perhaps a government funding, or perhaps some type of a loan, so we don't have dilution to our shareholders. But I mean, Antonio, there are a lot of exceptions to that. We'll see how the market evolves. We're going to talk, I'm sure, about M&A. We'll see how M&A goes, if there's any opportunity there. We would not fund M&A through debt. We would probably only fund that through some type of an equity raise. So we'll leave the door open, but right now I can say with a very straight face, we're not looking to do any equity raises for Lost Creek Shirley or any type of a debt facility. We're happy with the cash position we have right now. Got revenues starting to come in from sales into contracts.
I'm very happy you're bringing up M&A yourself, because that's on my list to talk about too as well, indeed. But do you just a couple of more points on building out Shirley Basin, because you just took the decision earlier this year. You talked about staff earlier for Lost Creek. Do you have the staff to build the what's not a mine, but to build the field then in this case?
Yeah, we'll need to do a little more hiring. Very, very little this year, a little bit more next year. But we have the geologic staff already hired. Some of my guys are out there today working with the monitor well installation. So that's ongoing right now. We've got plenty of staff for that. Some of the casing crew from Lost Creek went over today to work on that. So we're pretty happy with the staff there. But ultimately at Shirley Basin, by the end of next year, we will need to hire around 50, 55 people to staff that mine. one of the things I really like about Shirley Basin is it's relatively close to town, to a major Wyoming town of 60,000 people. I know to many of your listeners, that doesn't sound like much of a town, but for Wyoming, that's about as big as it gets. So it's relatively close to town. It's paved road almost all the way there. So we believe when it comes time to hire, it's going to be a lot easier to hire for Shirley Basin than it was for Lost Creek, which is a very remote mine. I mean, again, it's 2 hours from town. So that has presented some challenges. And it's a historic mining district. A lot of people in Casper have worked there historically, or they have family members that work there. So when we made the announcement that we were going to build out and ramp up production, there was a lot of excitement in the community. It's a blast from the past for a lot of people. I had a lot of calls and said, "Hey, John, great to hear you guys are ramping up. Let us know when you guys start hiring. Excited to get back out there."
Very interesting, and I like how you mentioned it. Like it's a very remote mine, is what you said. It's 2 hours from a town. There's someone in the Athabasca Basin listening to you right now and rolling their
Yeah,
eyes at that. But
right. In Australia as well.
correct. Are you finding that you have to offer more money though, or better benefits, or something than something more than what you had expected prior to getting into this in order to find and retain staff?
I think the one thing that we've done that we would not have done if the mine was closer to town is the compensation on the drive out to the mine. We pay the employees, the driver to go out. We provide transportation. It's not an insignificant cost. We've got several trucks running back and forth each day from Rollins, which is the nearest town, and from Casper. So our fuel bill is pretty high, and that's not insignificant. Employees don't have to drive out. Most of them sleep on the way out, and some of them sleep on the way home. So they can
Not on the job, I hope.
not on the job, but they get out there rested. So I think that's one of the big differences. But as far as wages go, we're very competitive for the region. In fact, I think we pay probably $2 or $3 an hour more than other similar industrial jobs. So I think we've been able to keep the labor cost under control, while at the same time giving just a bit of a premium for the region.
What about labor turnaround? Is there a lot of that? And I don't want to generalize. I don't assume. And pretty much the only idea I have of Wyoming is from watching shows like Yellowstone or whatever that I imagine how it looks like. Which means, again, I don't want to generalize, but I'm thinking serious people who take their jobs seriously, and
Yeah.
they're not like turnarounds like people in the city would change jobs, every 16 months or something like that. So how's
Yeah.
labor turnaround?
No, it's a good question, and we've had high turnover, especially when we were first ramping up at Lost Creek. The first 6 months or so, we did have high turnover. That's resolving itself. The people that turned out they didn't want to be there for whatever reason, they're gone now, and the staff we have now, they're much more stable. They want to be there. They've been there for a while now, several months to a year. They like it there. And so any new company or new startup on a project like that, you're going to experience that. And we expected that. It was true. It happened with us. I think our peers, as they try to ramp up in Wyoming, they're going to experience the same thing, where you bring good people out, but it just turns out not to be a good fit for whatever reason. So for the first 6 months, maybe pushing a year, you have relatively high turnover. But hopefully by the end of a year, certainly our experience has been much more stability, and I think our peers will experience the exact same thing.
Fair point. So labor is covered in terms of talking about it. What about permitting? You call it fully permitted. Does that mean actually fully permitted? Is there small permits or anything else that you have to get before you're actually producing drums
Yeah.
over there?
So at Shirley Basin, there were 3 major permits that are required. We work on a little bit of Bureau of Land Management land. And so we've got the plan of operations approved there. There is nothing else to do there. We have to get a permit to mine from the state of Wyoming. That is 100% done. Nothing else to do there. We also have to get a uranium recovery program, which is a state program, a nuclear license, 100% done. So the things I have left to do for permitting at Shirley Basin is the potable water system. Need to get that done. And then prior to building out the plant, I have to get the sign off from the county. We've met with the county multiple times. They are very supportive. But those are things like ensuring we have a properly sized electrical transformer. The electrical is being done per code. It's a building permit, essentially. And so those are the two things pending. Now, going forward, the state of Wyoming has to give us approval for every header house that we build. But that's an ongoing throughout the entire mine life. They review each one of those, and there are a couple of other things like that. I don't want to just be dismissive of them. They are important, but they are routine things we do almost on a monthly basis going forward.
Nothing that worries you, nothing that you think is
No.
going to possess a risk or a
No.
challenge.
No. The confinement, the hydrologic confinement at Shirley Basin is outstanding. We don't have any significant environmental concerns there. We're not in the sage-grouse core area. We don't have archaeological problems. Yeah, it's about as clean a story as you could possibly get in the uranium industry, and we've got very strong local support as well.
Yeah, good. Let's talk about that contracting though that I keep on talking about. There's basically two more things I want to talk about, and that's three actually: contracting, M&A, and then growing the company, either through M&A or drill bit. But contracting first. Who's calling who here, John? Are you having to actively go out and look for a home for that production, or is your phone mostly ringing?
So the way it works in the industry is the utilities and other fuel buyers, whenever they need pounds in the long-term market, they will send out an RFP, request for proposal. We routinely get those, and we respond to those accordingly with what our abilities are to produce. And sometimes they will indicate in the RFP that pricing mechanisms that they will accept. Sometimes they leave it open. But no, we routinely respond to those. And in fact, each of the contracts that we have signed, for the most part, I think there have been a couple that have been just, they called us up. But 4 of the 6, they've been in response to RFPs where we've prevailed and have been the winning bid, essentially. A couple of those, they've been very specific. They've said, we want U.S. production to reduce our risk. We want more diversity. And so we've been able to pick up a couple of contracts that way, since we are the sole producer in the U.S. right now, or at that time. We've got one other company now that's come online since then. But at the time, we were the only one producing. But that's how it works. We continue to see RFPs come in. Like I said, we're being a little more patient now. We're not pursuing them as aggressively because we think the market's got a little more room to run here. And especially as geopolitics continue to evolve. And we'll just continue to watch that and see where things go.
Once you get in touch with the utilities, what are they really interested in here? Are they really, do they really have anything to say here is what I'm asking? As in, are they asking for floor-based or ceiling limited contracts, or
Sure.
are you saying, no, I want market-related contracts? Are they asking for longer or shorter timelines? Give me the details.
Yeah, it's a mixed bag. I would say it certainly has become more of a seller's market than a buyer's market. That's really clear. I would say 3 years ago, 5 years ago, when we responded to RFPs, really the utilities would say, hey, we want fixed price. We'll give you escalation for inflation, but it's got to be a fixed price otherwise. And if you said, no, I want a floor and a ceiling, they would have said, no, thank you. But that's changed. Now, most, not all, but most utilities are saying we will consider collars with a floor and a ceiling going forward. Certainly, that is our preference. Since we sell into the term market, the long-term market, one of the criticisms that we get is, hey, you're giving up your blue sky. What if the price goes to $130 a pound and you've sold at 90? My response to that is the contracts we've been signing most recently are with a floor and a ceiling. And I can't get into the specifics there too far, but the floor, it protects us on the low side. It gives us a very good profit margin on the low end. If the spot market goes low, we're protected by that floor and still make money. But on the cap on the upper side, it protects the utility, but it also gives us a lot of room to run and get into much, much higher pricing if the market gets hotter. So those are the type of contracts we're pursuing at this time. Most utilities, not all, are agreeable to those at this point. But the utilities, they're looking obviously at pricing. They're looking at diversity. They are wanting to de-risk more and more as geopolitics devolve. I won't say evolve, I'll say devolve. So they're looking at that diversity of region. They're looking at production reputation. Have you been able to demonstrate historically that you can produce? There are some entities out there that are going to be successful, that are ramping up or trying. Some will be successful, some probably won't. So the utilities are trying to tease that out. Who do they think they can take the risk on going forward? So yeah, they're looking at that certainty, diversity, pricing, all of those things are what they're looking at.
How do you think that pricing is going to evolve for you? And I mean the effective pricing, because the contracting can get complicated. But what I'm looking at as a potential investor here is like, okay, 570,000 pounds this year, 33 million bucks in revenue. As we said, 50, what do we say? 56, 58 bucks, I think, a pound,
58,
something like
yeah.
58 bucks a pound. How's that going to evolve? Is it reasonable to expect that as you keep, I mean, as you go into these contracts and you ramp up to full production, are you doing what, 60, 65? What is your expectation that you're doing at that
Keeps
point?
going up. It keeps going up. It keeps going up because of the inflation protection we have built in. It also keeps going up because of the floor and ceiling and some of the other contracts, later contracts we've signed. It gets us into much higher pricing going forward with protection on the floor. So yeah, we would expect to see that over the next 5 years. The pricing that we get on those contracts will continue to go up fairly significantly going forward.
Do you have an idea of what that would mean more specifically? Like you said, full production, what, in 2027 would be sort of your first year of that 2.2 million pound production. What would you think the average price of they would be there?
I know what the number is, but I've not divulged that, so I can't do it here. We'd have to disclose it through an SEC filing or something like that. But yeah, it's fairly significantly higher than what our early on contracts are. And I would comment too, Antonio, one of the reasons we're one of the first ones to go into production as the market has come up is because we have low cost production. So that delta between our cost of production and our contract price, we're happy with that. Even in those lower price contracts, we're going to make some good money there, some very good revenue on an all-in basis. Some of our peers that have waited to get into the market and make those decisions on a production, they've had to do that because their cost of production is significantly higher. So they had to wait longer to get into production to get the profit margins that we were experiencing 18 months prior.
And I'm speculating here. I hope I'm not putting any words in your mouth, but 50% increase on that, 20% increase, excuse me, 20% increase on that price will put you sort of in the $70 range. At 2.2 million pounds, then you're doing 154 million dollars in revenue. And that's a decent chunk, obviously, at this valuation, but for any company. But as it always is with mining projects, your assets are depleting in the meantime as you're generating that revenue. And so this is where we go to the second point that I wanted to discuss here. What do you do about that? How do you go about it? Do you look to grow through the drill bit, or do you go and look for, you know, ready to be mined pounds from one of your peers?
The answer is both. Let me talk about our two flagship properties quickly. I mentioned Shirley Basin. We don't have to do much drilling there because it's been drilled out very heavily. There's not much room to grow that particular project through exploration on our current land package. It's drilled out, it's defined. There's really not much upside potential there. Maybe we have some success acquiring some of our neighbors. We'll see how that goes. I think that's probably likely in the long term, since we will have the only mill in the region. It would only make sense for those pounds to come through us through a joint venture or some toll milling process or outright acquisition. So can't talk much about that. That's in the future. There's nothing line of sight there. Let me switch gears to Lost Creek. Lost Creek, we've got about 35,000 contiguous acres in the Great Divide Basin. We've done 6 exploration programs, all the way going back all the way to 2006. Every one of those has been successful at identifying and bringing more pounds into NI 43-101 compliance. Our average discovery cost has been around 50 cents a pound over those 6 projects. That's fantastic. We believe, and this is a forward-looking statement, but we believe that we'll be successful with additional exploration there going forward. The mine of life right now at Lost Creek is around 13 years. So we've not been real excited about going out and spending capital on exploration. We believe those pounds are there. We will get to it. So as we get ramped up in production, as we get more drill rigs on site, and get a little more distance between production needs and drilling, we'll begin to dedicate more and more of those drill rigs to exploration. Not this year, but I hope next year we can put 2 or 3 drill rigs on exploration to continue to grow the resource base, replace what we've put in the can. So that's the near term, or the next year or two, how we look at exploration there. We have some other exploration projects that we may dedicate a little bit of time to in the Great Divide Basin. We'll see how the drill rig count goes. But the other way to grow the company is through M&A. And our mantra on this has been consistent for many, many years. When Jeff Klindo was sitting in this chair, he always said that if we get married, we're going to get married with someone who looks like us. In other words, it's a producing company with quality assets. That's my same mantra. When we look at M&A, there's been opportunity in the past 10, 15 years. We have been very stingy. We've been very disciplined. We go out on a lot of dates, but we've only made one acquisition, and that would be the Pathfinder assets where we picked up Shirley Basin. So going forward, we're going to continue to go on a lot of dates. We're going to look hard. But if it doesn't look like it's a project that we can put into economic production in the relatively near term, and say that with a very straight face, it's not for us. So we'll be disciplined. We'll watch and see how things play out. I would say, though, that I think we are at a point in the industry where some assets that have not been put into production, the owners are looking at them and saying, if not now, when? Spot price is $90 a pound. Are we going to produce this or not? Is uranium a commodity we're interested in or not? So I think there are some assets out there in the US, Canada, globally, that it's time to make decisions. And I think companies are looking at those hard. Some of them will say we're going to go into production. Some of them will say we're not going to be a uranium company. We're going to move toward lithium or gold or copper. We think those are the hot commodities going forward. And if that's their decision, then it would make sense for them to divest of those assets. So I think over the next 1 to 2 years, we're going to see a lot of M&A in the space. So maybe not so much the M, but the A with the acquisitions as companies divest themselves of uranium assets. So we'll see how things evolve.
You also got the Lucky McMine site with one of your acquisitions.
Yeah.
Yeah, I mean, do you want to do something with it this year? Or when would you like to go to it?
Yeah, so Lucky Mac, we were successful in completely reclaiming that. The liability is 100% gone on that. It's just a piece of private land we own. It's got probably around 4 to 4.5 million pounds of resource. Those are historic resources. Those are not NI 43-101 compliant. That's what the previous owner was estimating the resources to be. It's not something we're going to pursue right now. It's too small of a resource base for us right now. There are some other projects in the region that would make sense for them to be wrapped up in. And so maybe at some point we sell that asset, or maybe we acquire another adjacent asset that it would make sense to put those into production. But right now, that's a perfect example of an asset that I can't say with a straight face we're going to produce it, because we're not. It's going to require more pounds. And so we're not going to really advertise that much or talk about that much, because it's not in the production portfolio just because of size constraints.
No, John, how it works is you list it as a different company, you put it on the TSXV, and you promote it.
Turn it into a $200 million market cap, right?
Yes, exactly. There's pounds in the ground. They're worth something, right?
Yeah.
Supposedly. No, okay, but so what is the timeline to actually get more active on it? I was gonna say serious, but not serious, because you're serious about this, but more active. Like, when do you get more active on growing the company? Because over the near term, by 2025, so we're talking, say, 18 months, the focus within those 18 months has really been surely based and let's get this thing into production. So does it come on the back of that? Do you wait in between? When do you get more active on there?
So the great thing about our company is I've got an extremely experienced senior management team. Most of us have been with UR Energy for around 17, 18 years in the uranium space with production. We have a new VP of regulatory and Ryan Sharman. He's been involved in the uranium space from production and the regulatory side for many years. We know what we're doing. We've got gray hair. So the beauty of that is I can turn production over, Shirley Basin construction. Our chief operating officer, he handles that. So I don't have to be involved in that on a daily basis. So when it comes to the M&A discussion and being serious about that, my hands are free. I can focus on that as I need to and be serious about that. And to stick with that analogy, go on a lot of dates, have a lot of discussions. And so we're looking at those things very seriously right now, as seriously now as we have ever been in the past. So who knows if any of those discussions bear fruit. I would caution your listeners, though, that I'm not tipping my hand here. Those M&A discussions in the mining industry, they're ongoing all the time. CEOs, boards are constantly talking with each other, looking at what would make sense on the M&A front. So what I'm saying here is consistent with what happens in all commodities, including the uranium industry. There's nothing special or unique going on that I'm tipping my hand on. So don't go out and buy shares because John said we're going to make an acquisition. Don't do that. What I am saying is we're always looking hard. We've looked hard in the past. We're looking hard now. We'll continue to look hard in the future for those quality assets that we can bring into economic production.
Is there any dating going the other way around too, where you don't invite companies on a date, but a bigger company comes and invites you on a date, like the M&A the other way around? Is that something that happens?
It does happen from time to time.
Hmm.
And again, we've always said you got to look like us, otherwise we're not interested. Our shareholders, especially our shareholders, we communicate with them regularly. They tell us what they want from us. They tell us what they want us to look like 5 years from now, 10 years from now. So we have very clear direction from our board and from our major shareholders of what we should look like. And that really tells us what M&A discussions should look like. So we stay in bounds. We've been provided those bumpers and we honor that. They are our bosses and that's what we do.
Hmm. You're mentioning the board here, and that's one last point that I wanted to go through, but you recently appointed two new board members, I believe.
That's right.
Yeah, what's happening there?
Yeah, so our board, we've had a very stable board for a very long time. And we've had two board members retire. Jim Franklin he was a founding director, has been with the board for since the very beginning. He started in 2004, so 20 years he's been with the company, and he's retiring. And then also Bill Boberg, who has been with the company just shy of 20 years, but we'll call it 20. He was also a CEO for a while of the company, brought tremendous experience. But we're just reconstituting the board. I want to be crystal clear. There are no internal problems whatsoever. It just was time for some refreshment. The gentleman retired, and we've brought on two really excellent candidates onto the board. JP Pressey is joining us. JP has been in the commodities industry doing auditing with PwC for many years. He was a partner there. So he brings tremendous audit experience onto our board. That is one of the very strong points that we wanted to make sure we grew on our board. And he brings that in spades. He's an expert at a very high level. The other gentleman we brought on is Elmer Dyke. Elmer has been in the nuclear industry his entire career. He worked for the State Department. He's worked on non-proliferation issues. He was CEO for Centrus for a while. I would say he's one of the leading experts, especially on the back end of the fuel cycle with power generation with small modular reactors. So we're very pleased to have those two gentlemen on the board. We're very sad to see Jim and Bill go, but we're very happy to be bringing on a couple of new names that will just continue to strengthen the board going forward.
Got to let people rest a little, John. I mean, they've worked their whole
Yeah.
life, so I get it. You
Yeah,
also have
Jim and Bill are both into their 80s now, so yeah, it was time.
you also have a VP of regulatory affairs that you're taking on. What's the Yeah, what's the meaning of it? I mean, the way you
Yeah.
explained the regulatory process, it sound like you could manage that on your own. Why do you need a VP?
Yeah, no, good question. So before I took this position, I was the VP of regulatory. I've been in this chair now for a little over 2 years. So for the little over 2 years, I've been handling the VP of regulatory plus CEO duties. It's
Hmm.
too much. I can't continue to do that. And to be honest, there was probably a mistake on my part. I probably should have brought a new VP on much sooner than this. But we're glad to have Ryan Sharman on. Ryan is a certified health physicist, which is a designation that's very difficult to get. He's worked as a radiation safety officer at operating mines. So he's got a great experience in Wyoming. But perhaps more importantly, he was hired by the state of Wyoming to stand up the uranium recovery program. So when Wyoming became an agreement state in 2018, it was Ryan who stood up that program and managed that program for years. So he has in-depth insight to the regulatory regime from the state and the NRC perspective, from the land quality perspective. That gave him the ability to be an inspector for every NRC licensed facility here in Wyoming. So going back to the M&A discussion, if and when we go look at a site to see if we want to acquire it, Ryan can hold up his hand and say, hey, I was the regulator at this site for years. I know their people. I know the warts. I know the violations. I know the permitting status. So he's a tremendous tool, not only for management of permitting and regulatory affairs for us, he's also an incredibly important player when it comes to our M&A team. So we'll be utilizing him for that as well.
Two birds with one stone. I like
Yeah,
it.
absolutely.
Good. Well, John, we've talked about all the news releases that you had in between this and our previous call. We even talked about Bisons. So it's been a fun conversation. What am I missing? What am I forgetting to ask you here? Anything else you want to leave me with?
Just geopolitics. I'll touch on that. I know your listeners keep up with that, probably even more so in Europe than here in the US. But not so long ago, President Biden did sign into law the ban on Russian material being imported into the US. Um, it's enacted here very soon, 90 days after signature. So very quickly here, that'll come into play. There is a waiver process up until January 1 of 2028. But January 1, 2028, there is a hard cutoff. No more low enriched uranium will come in from Russia. And that's in place for a number of years through 2045. I could be wrong on that, but for a very long time. That's important to us. It has had an effect on the spot market. I think that situation will continue to evolve. We're not clear exactly how the waiver process will work yet. We're not clear how Russia will respond to that yet. There's some discussion going on, but resolution is not clear yet. And I think very importantly, we'll continue to see how that impacts, if it impacts Kazakhstan and Uzbekistan and their primary uranium production and where it goes from there. So a lot going on there. Just recently, a couple of days ago, President Biden also had a meeting at the White House where he announced additional support for the build out of new large nuclear reactors here in the U.S. For your listeners, we still have the largest fleet of operating reactors in the world here in the U.S., and it's growing. We're looking at two just came online with Vogtle. One more will be restarting with Palisades, and the White House is throwing their support behind additional reactors. They also announced that the U.S. military will be looking at speccing out small modular reactors in the not too distant future. So the industry is growing. We're seeing increasing government support, still a lot of uncertainty due to geopolitics, and that's putting pressure on the price. So a lot to continue to watch, a lot of catalysts going forward.
And I hope you're going to keep updating me on all these things, John. But again, as I said, thank you so much for doing this. I really appreciate it.
Yeah, thank you, Antonio. Really appreciate the opportunity. And maybe just one other thing I would point out is we are going on to the Russell Index at the end of June. We are beginning to see our volumes increase on the shares. So our liquidity has always been good, but it's improving. January 28th, we expect to see a lot of trades on the shares, perhaps tens of millions on that particular day, because those indexes that hold the Russell shares, they are required to buy on that day. So we expect to see ever improving liquidity in our shares.
All right, well, thank you, John. Again, thank you for doing this. I always enjoy conversations, even if it's about bisons and whatnot and animals. I'll be in touch in a couple of months to get an update on how everything's going at Shirley Basin, production at Lost Creek, and so on and so forth. So I'll let you drop off now, though, as I will be traveling up to Canada. And not for the nice weather, unfortunately, but I am instead going to Quebec to look at 2 titanium projects and hear about them from Kyler Hardy, the executive chairman of Temas Resources. The company is listed as Temas, so that'd be TMAS on the CSE in Canada, where an average of about 85,000 shares trade each day, with a 52-week high of 47 cents and a 52-week low of just 3 cents. With a market cap of about $6.5 million and about 22.5 million shares outstanding after the recent consolidation, today this is a 30-cent stock. There are almost 10 million warrants and 1.4 million options, leaving us with about 33.5 million fully diluted shares. And about a quarter or so of the company, so almost 25% of the company, is owned by insiders, and another almost 45% is believed to be owned by friends and family of management and insiders. Looking at the latest balance sheet, which is dated December 31st and covers the fiscal 2023, the company had about $360,000 in current assets, most of which, that was at the time $270,000 to be specific, was in cash and cash equivalents. No long-term debt, but there was a rather high amount of account payables and accrued liabilities. It was sitting at $1.2 million, so they were related to insider transactions. Again, something we might be discussing later on, but also it's worth noting that since this report was published, the company has done a private placement and raised $1.7 million. That same financial statement from December also tells me that on average, over the last reported fiscal year, Temas spent about $63,000 a month on administrative expenses, which is about 25% less than what was being spent last year. And of course, I'm not counting stuff like share-based compensation and stuff like that in here. But it's simply, this means that, again, excluding that share-based payments and stuff like that, and I'm rounding up as well, the company spent about $100,000 a month on average over that last reported fiscal year. About 40%, call it between 35 and 40% of which went into the ground. So about $35,000 a month was spent on exploration and evaluation, or on the projects, so to put it, which is it's a good deal less than what was spent last year, where that spent sat at about $250,000 a month. But that's going to make sense why that's the case later on in the conversations related to a PEA and whatnot. But again, you're going to figure that out. Same thing as always, though. You need to understand that this is nothing more but a snapshot in time that I'm going through here. In this case, it was specifically at the end of December of this year, and the finances will have changed by the time you're watching this. So please go to the company's website as well as setterplus.ca and look at all the numbers yourself to make sure that you're getting the full picture and understanding all the numbers. Fun stuff aside, though, as I mentioned at the beginning, Temas is a titanium-focused company. It's actually a titanium dioxide iron development company with 2 advanced stage assets in Quebec. The most advanced of the 2 is the La Blanche project, of which the company came out with that PEA earlier this year, so that's where the spend of last year was coming in on. That PEA showed the potential for an open pit mining operation here with an over $6.5 billion, and that, yes, that is B, so it's a billion with a B, $6.5 billion NPV 8, and an over 60% internal rate of return, both of which is those are post-tax numbers. The life of mine here is estimated at 14 years, whereas the payback period is estimated at a little over 2 years, during which the $1.2 billion initial capex is expected to be paid back. That $1.2 billion capex, by the way, will be spent over a period of 2 years as well. So the company basically believes that that's enough time to get from project financing to production, and then 2 years after production, the capex is expected to be paid back. Of course, that's not a small amount to finance upfront for a company of this size, so the conversation will target that later on. But when all is said and done, the net revenue and the net EBITDA on this project over that 14-year LOM are expected to be 34 and 21 billion. Yes, again, billion with a B. So 34 and 21 billion dollars respectively. The second project, so that's the main focus here. It's the flagship, the most advanced project. But then there's a second project, as I mentioned. It's called Lac Brûle. It's also in Quebec. It's to the south of La Blanche, and it's ready to go into the PEA stage after some additional drilling, potentially this year. Again, something to be discussed later on. And judging by the drill intercepts from previous programs on the project, as well as some preliminary met work that's been done on the project, I believe in 2022 or something along those lines, as well as combined with a VTEM survey that outlined a 2.5-kilometer conductor, as well as the potential to grow this asset. All of this suggests that there is room to grow the known mineralized zones, as well as find new lenses of mineralization, given that historic drilling in the project covered only 2 mineralized lenses. And so there is the potential to come out with a big PEA on this as well. Again, mentioning potential, this is the forward-looking statements we typically reference in these conversations. And as always, and actually, as I'm saying this, because I'm mentioning a big PEA, as I'm saying this, and looking back to what I said about the size of the market cap here, Kyler, this is where you come in. But I can't help but wonder, what the heck? Like, I mean, there's one over $6 billion asset, the potential for another one, yet you're trading at less than $7 million in market cap. Well, also the share price, by the way, has gone from over $15 in 2021 to again a low of 30 cents a few months ago, which granted is now recovering and it was under different management and whatnot. But what's wrong? What am I missing?
Well, that's a great introduction, and what you're missing is the simple fact that we've only just started re-talking to the market and actually advancing this company as a junior company should be advanced systematically and establishing controls and building out a portfolio of projects, which wasn't necessarily happening before we came back in to take over.
And I guess financing could be part of this too, right? I mean, as I mentioned, you have a project, again, huge MPV, but also no small capex, right? $1.2 billion is not easy to come by for any company, but definitely not for a company of your size. So is there, I suppose when you came in and kind of took back control of the company, I assume or hope that you came in with kind of a plan to tackle that issue. So what's the strategy for dealing with the capex?
Yeah, so just actually to touch right back on the previous topic, and I'll touch on the capex here as well, is when we reseeded the company last fall. We did a rollback on it about a year ago now, and we completed a small financing here just recently as well, just in order to move that project forward. Historically, we'd told the market we were going to deliver a PEA, and lo and behold, 3-4 years later now, we finally have a PEA in hand. It took a while, and the high of over 15 was pre-rollback, or sorry, post rollback numbers, which was about 150, 125 to 150 million market cap, somewhere in there. And it just got ahead of itself, quite frankly. The market apparently liked what it saw, and wasn't the company wasn't moving fast enough to backfill that valuation. Hence, it came off. So as a result, the current management and directors came back in, restructured, executed a number of initiatives, including a drill program to confirm the resource, and which we actually doubled the size of the resource on the project through inclusion of a skin on top of the primary lens, a lower grade skin, but you're making money from surface down now. And additionally completed some met work, and obviously the PEA, which we now have in hand. So to answer your question, the disconnect between the market cap and the NPV of the asset is we had to backfill a whole bunch of pieces. Now we've got those pieces backfilled. We've got that PEA in hand. Now we can start to revalue the company, hopefully with some percentage of that PEA valuation. The big question now moving forward as well, okay, this large capex. It's a PEA, so it's a good initial document. We have to delve into that capex now. We have to move in towards completing a pre-feasibility and feasibility study, which will hopefully tighten that capex number up a little bit. But as part of a plan, in order to deal with that larger component, it is getting through those two more studies that we have to do, or two overarching studies with multiple small studies underneath them, obviously. And our view is that once we get to completion of a pre-feasibility study, we can either attract a joint venture partner to move this project forward, someone with a large balance sheet, that some of the vertically integrated titanium dioxide producers, all the way from mine face to end chemical products, or we can sell the company at that stage, which should make a valuable acquisition target to add to someone's portfolio, whether same groups, chemical companies, vertically integrated, or another miner. And it's taking a systematic approach, like we talked about right off the bat. Is next study, tighten this up, make it into a product that a third party can get involved with at that stage.
I'm also wondering, like, if those are the two main goals, so get a strategic partner in or find someone to buy this off of you, why stay public? I mean, if you're not raising equity to develop this thing, which would also just be pretty much impossible to build this thing only on equity, and you can maybe, if you can find the money to develop this elsewhere in the strategic partner or someone who buys it, and given that management and, again, friends and family already own about 70% of the company, as I mentioned, this was 3 cents at a given point, so that's 90% lower than it is now. That's less than $1 million. I mean, it wouldn't be too hard to take it private at that point. So even if it's at a premium, so why not? I mean, why didn't you take it private? And why not take it private at this point?
Well, great question, and we did contemplate that very heavily, and ended up getting to a point where we didn't necessarily think it was fair for the shareholders that we had in there, that longer term shareholders, for them to have to suffer on and go private. Canadian markets are very nuanced, as you'll know. The venture capital for development of resource projects is a lot harder to come by privately than it is publicly. Albeit right now, I would say that the Canadian markets aren't necessarily conducive to good financings, just due to some structural flaws, I think. But taking it private versus taking it public, we thought that the opportunity for a public valuation on the asset was considerably higher than a private valuation at this stage, and that's the reason we kept it public. We probably could have sold the project for a pretty tidy sum privately, but at that stage it did not make sense for us.
It basically says that you're hoping to get a premium on the public markets than what you would get privately. Was so far, again, it's not happening. You're saying you're restarting marketing and you're restarting telling the story, basically. But why hasn't, well, if you're not taking it private, and the other option was, again, just maybe you sell it to someone else, why is nobody buying this from you as it is right now? I mean, if I were a large developer, and I don't know a lot, but if truly nothing was wrong with these projects, 7 million, heck, 5x premium, okay, whatever, it's $35 million, still chump change for these large companies, for the Rio Tintos and whatnot. I just knock on your door and get the deal done in a week. So why has that happened yet?
So a couple of things. We're not at a stage where it makes sense. There are other advanced assets that somebody can come in and acquire right now out in the broader market. There are some great titanium dioxide projects out there, mineral sands across Africa, mineral sands in South America, whereas we're a hard rock project. Hard rock is there's a few hard rock projects in operation globally right now, including the Temas mine owned by Kronos Worldwide in Norway, and the Lactio mine owned by Rio Tinto in Quebec, about 400 kilometers to our east. Both very similar to what we're working on here. Those companies don't necessarily need to come and buy something right now, even just to get rid of it, get it out of the market. They would rather see us advance this through pre-feasibility study. And so that's what we're going to have to do. We're going to have to raise some additional capital, move the resource from inferred into measured and indicated, do some additional metallurgical work on it, optimize that study. We do have to do some work on the lower grade rind that sits on top of the primary lens. We want to move that from a 50% recovery and see if we can't get it over 70%. We think we can, but it's a study that we have to do. And in their opinion, they would rather see this through a pre-feasibility study rather than say, okay, well, PEA, it's a start, but let's get this, let's let them advance this further and see if they can move this forward on their own. And right now, at what I consider the start of I would say a major bull market in the resource sector, M&A is just starting. The majors, the mid tiers are just starting to acquire junior companies, smaller projects, earning into these projects. You're seeing groups like Hudbay and IM Gold doing pretty significant bought deals to go out and acquire projects, invest in third-party projects, enhance their own production and exploration. So you're starting to see that right now, and I would say it's not in full acquisition mode yet. It's everyone's sort of tiptoeing around, going and picking off assets here and there, but not the fever that we would like to see, and I think that we will see into the next few years.
What do you know? How many? Let's start that. Who's a potential suitor for this? Like I mentioned Rio Tinto as an example, but now that I'm thinking about it, they're actually a potential suitor for it. Who else?
So a couple of major suitors globally. Rio Tinto, obviously, they're mining a very similar deposit off to the east at Lacteo. You have Kronos Worldwide, which mines the Telnez mine right now, which is getting a little bit long in the tooth. They're going to need to replace that production at some point in time. They're a vertically integrated titanium dioxide producer, so they take it from mine face all the way through to custom built or custom designed titanium products at the end. Tronix is another very interesting suitor. From our understanding, and I'm not sure this is entirely accurate yet, they're starting to look for projects in North America to enhance their footprint here. Again, they're another vertically integrated producer and refiner at the end of the day. Also, groups Iluka out of Australia, becoming a pretty significant TiO2 zircon producer globally, and they're acquisitive and primarily in the mineral sands sector right now. But I think that they could start to see an opportunity in the hard rock sector, especially if it gives them a footprint in North America. And why I keep coming back to this North American component here is the amount of money that the Defense Department out of the U.S., strategic minerals investments out of Canada, that's being thrown around right now. A lot of these companies want access to that capital, and it's a lot easier for them to get access to that capital if they have projects in North America. Excuse me. And so there's an incentive for them to find projects in North America. We can go into East Africa. They can go into Madagascar, West Africa. They can look at projects in South America, but it doesn't have. There's different buckets that these government organizations are deploying into, and the biggest bucket right now is North American centric projects. So to get access to that, eventually some of these guys will start to pick up projects in North America, and have already started looking at projects in North America.
Are there many other comparable projects, like large projects like yours in North America?
There are a few, mostly owned by juniors similar to us, some private, some public. But I would say at this stage, we're probably the most advanced of the hard rock projects right now, and the most public. There's a few that are coming public that we know about. Hyperion X is a really interesting example as a direct comparison to us. They're approximately a 450 million market cap, listed between the U.S., believe NASDAQ and the ASX. They've got a PEA level project, I want to say in Tennessee, but they've also got a suite of technology that they've built a pilot plant out in Utah, I believe it is, and they're more heavily focused on the technology component of their company, which is going very well for them, it sounds like. Whereas we're more focused on our resource, and our resource is 6 to 8 times the size of what they've got in the ground. So there's an argument there and a direct comparable to what we're doing.
It sounds like it's a supply demand thing, as in how much demand is it for these type of projects, and how much supply is it of these projects. So, and what you're basically telling me here is that maybe currently that's tipped over towards the supply side, as in there's more projects in the market that there's demand for within the majors, but you're expecting that to shift, and you think that's going to unlock the value. Over what kind of a time period are we talking about? Like, what do you expect? When do you expect these things to start happening?
Over the next, I want to say 5 to 6 years, we're anticipating several major projects come off or slow production down over that period of time, and they're going to need to look to replace that production. Right now, the titanium dioxide market's growing at just over between 5 and 6% per annum. And it's currently a 19 billion market. Over the next 10 years, we see that getting north of 30 billion. But it's used in things like paint, plastics, paper, and things that we need every day. The reason the paint in your house is bright is because there's titanium dioxide in it, and that's not going away. Another key component is further refining titanium dioxide into titanium sponge used in the defense and aerospace industry, right? We're not including that in our projection and figures here right now, just simply because it's a further refinement. It's a very small niche market. But with that said, part of that strategic mineral component is having titanium available to the North American market. Recently, Bombardier, one of the Canadian aerospace companies, just got a hall pass to go and buy titanium from the Russians because there's just not enough supply of titanium right now in the West. Most of the mineral sands, once it's concentrated, gets shipped to China in order to be processed there. So again, you start to look at this micro markets within a broader market that, okay, now China's processing. They've got that titanium in country now. They can use it for themselves. They can't. We don't have access to that generally, and you're seeing that with commodity controls around things like graphite. You'll probably see it around titanium pretty soon. Rare earths, that switch turns on and off seems like almost like a bi-monthly basis. And so I think that we have an opportunity here to become a major supply point within North America for the broader be it industrial or aerospace and defense industry.
Is there a royalty on this project, Kyler? By the way, I just thought of it as you were talking about these things.
Yes, there is royalty. There's a 2% royalty. I own that royalty as I put the project together and initially bought the project privately.
Oh, is that buyable?
It is buyable. Yeah,
Okay.
there's a half buy down on it for, I can't remember what it is, honestly. I believe it's $1 million and a half at some point. But it's held in a blind trust, so I don't have control over it.
How much of the company do you own personally?
15, just shy of 15% right now.
15%. So that would be a 1.5 at 10. We're at 7, 30% down. So it's $1 million worth, something like that.
Yeah, plus or minus. Yep. And we continue to add to our position in the market when we're not black or grayed out. Absolutely. You can look back at the trading history, and we're very active buyers.
Do you know what your average cost of capital is for those shares?
I don't know, honestly, off the top of my head, but I'd have to say, we were big shareholders before the rollback and have been active in the market post rollback. We have to be in someplace in between 15 and 18 cent average price right now.
Why
We
I'm asking these questions is because I'm
yeah,
trying to figure out if there would be a conflict of interest here between you owning that royalty and also having those shares. Because if the value of your shares does not exceed the value of the royalty, then do you have an interest to advance this project on a timeline that makes sense for shareholders too in terms of dilution? Because well, clearly you have two interests that are separate, right? You have the royalty and then you have the ownership of the company. Which one is the larger one for you, and how do I know you're going to balance that correctly?
good point. And I think royalties are a funny business. I've been involved in the royalty business for a long time, either buying them or creating them, energy royalties and mining royalties, and it's very rare that they ever come to fruition. I think that the advancing the company from a project, but also corporate point of view, getting those shares more valuable is front of mind for me. I continue to buy in the market. I continue to participate in our private placements, and we can't advance this project without uh, at low market caps like we're at right now. We need to increase our market cap in order to reduce our cost of capital moving forward. And it is a tricky balance, obviously, at the end of the day. But I basically discount valuation on royalties to nothing until they're in production. So it truly is an equity story for me. And yeah, I'll be in the market as well as in the private placements moving forward.
Yeah. It's also maybe a bit different here because of the size of the capex and the expectation for this getting built while you're around. Um, like it's not like you're building this thing yourself. Even if your market cap goes 10x, your
Yeah.
market cap goes 100x tomorrow, which again, I'm not saying it would or it would not, but even if it did, it'd still be challenging to get a $1.5 billion to build it, right?
I have to be honest with you. My view on juniors building projects is pretty low.
Hmm.
I'm a big believer in juniors should take projects through advanced studies and then bring a partner in or sell themselves to a minor. Junior exploration and development companies have a certain skill set. It's being startups, it's being entrepreneurial, it's moving things ahead at a rapid pace. Once you get to a certain spot in the development of a project, it inherently makes sense to bring somebody with that large engineering and project management capacity, and especially on a project of this size. So that's where you have to start to look at majors and mid tiers that do have that mine build capacity, that their cost of capital, is 5, 6, 7% if they're going out and issuing a bond to build something. We're not going to be able to achieve that same cost of capital, no matter how we move this forward. If we moved this forward, we'd have to be selling forward offtake agreements. We'd probably have to sell some sort of a royalty or net profit interest. We'll have to take a debt component. We'll have to do equity, and it'll get to a point where it doesn't make sense for a junior to, especially of that size, in order to move this forward. So that's why we look at joint ventures and sales of the company or sale of the asset moving forward at some point in time, once we've established the final value or a strong value for the project. So it's and I'm very much on public record of saying this, that typically I don't think juniors should go into production.
Yeah, well, fair point. Because of that dilution issue, but that's also making me think about what's your. Well, you must be thinking about this royalty. You say you value it at zero for yourself, but sometimes it must be popping in the back of your mind, and I just want to know like how you think about it, as in like if you wanted to, and as an executive chair, you could go ahead and tomorrow like vote for it to be bought back, not 50%, but like 100% or whatever for say 3 million, 3.5 million, which will be like a 50% dilution. But I don't assume that's your plan. But what is your plan with this royalty?
So I couldn't actually vote it. There's
Okay.
very clear very clear conflict of interest, uh, policies and procedures in place where I would have to abstain from any vote like that.
Hmm.
Um, I would have to get, and like I said, I don't have control over that royalty. It's in a trust. Someone else would vote it on my behalf. The company can always make an offer on it. I wouldn't be involved in that process, not even remotely. There'd be a third party that would come in, give a valuation on it. The trustee would do a valuation on it. They would come to an agreement. I would have to abstain from that entirely. So I, I've got all kinds of delusions of grandeur that I'd love for that royalty to be worth millions and millions of dollars, but it's being in that business for a long time, it's I just know the reality of it, and it's maybe at some point it will be, but not anytime soon.
Right. Okay. But so your initial idea would not be to have Temas buy that royalty, but you sell the project and then you have the company that buys that project buy that royalty, or you just keep the royalty. That sort of your plan?
Yeah, if the opportunity came along for Temas to buy that royalty down, absolutely. If it makes the project more saleable, absolutely. I think that there's more value in the equity of the company than there is in a royalty. And if removing that royalty at the right time makes sense, then in order to make the project saleable, let's get rid of it. It's again, like I say, it's not worth anything at this stage. At some point, it might be, but right now, it's the equity that is truly the valuable piece of it. And as we move forward, in order to reduce that burden, hey, let's get rid of that royalty. But until then, it's irrelevant.
So, okay, so as far as I understand it so far, and just kind of summing up what you said, royalty is currently worth zero. Royalty is really only worth anything if the project is built or
Yes.
if it's bought back.
Yeah.
Temas does not have the ability to do either, but the stock has the ability to go up for you. So that's why you care more about the stock than the royalty. That's what you're saying.
Yeah. And you know what? An opportunity to see 5, 10, 50x of the stock, I think is quite compelling. And then we've got the second project in there, the Lac Brule project, and there's a multi-project approach to this. It's not just one project. Maybe hypothetically, let's say we find a joint venture partner or a sale partner on La Blache. That moves, that heads off into the sunset to be developed. Now we've got La Brule to build up and move it forward, get it through PEA, get it into fees, maybe get another joint venture partner in, or sell that project at the same time, or sell the company along with that project as well. So it's not a one project company. We've looked at a dozen projects globally as well that could dovetail into this company to enhance value. But right now we've got such a large project and a really great second project that it doesn't make sense to bring something else in. We've got our plate, we've got our dance card full here for the next few years, I'd say, in building up a multi-project company.
And the royalty is, we're talking about specifically about La Blache, but
Yeah.
there's no royalty on La Brule or?
No,
Okay. Okay, good.
it's free and clear of royalties.
Right. I do want to talk about both of those projects. Let's maybe dive a little bit deeper on La Blache here. There will be, was it going to be like 3 end products coming out of this mine? So titanium, vanadium, iron. Is that it?
Correct. So in our PEA, though, just to be clear, the vanadium was not included in the flow sheet or in the final economics of the PEA. We wanted to do some more work on it before including it. It's also a very small component of it, so we didn't include it. So it's primarily a titanium dioxide and iron ore project.
Okay. Why I'm asking this, and this probably has to do something with why you didn't include vanadium in it, but I'm thinking about how confident you are in the metallurgical results here, results, given that, as far as I understand it, you're using your own technology, sort of a new type of technology, if you want to say it that way, for the potential processing of the ore here. But there's also really been limited testing, as far as I could figure out. Like, this hasn't really been done at scale. So I guess a twofold question here. As I said, how confident are you in getting to these actual numbers on a metallurgy that are stated in a PE, and how much margin for error is there really with this technology?
So with the technology, it's a chloride leach process, and the process itself isn't new. I would say um, it's been around for 3 decades. It just
Okay.
hasn't been applied in a on a very specifically. It hasn't been applied on extraction of TiO2 and iron ore. The use of chloride and hydrochloric acid in the stainless steel industry is widespread. They bathe that stuff in the steel in hydrochloric acid all day long, and as a result, we can point at that and say, as far as wear goes, it's established that it's already executed on an industrial scale. Taking it back to the actual process itself of extraction now using this the ORF technology, which we're a 50% owner of, is there is one project in China that is in operation, and I was just reading a paper the other day, and I just can't recall off the top of my head. There's another project that is using this type of technology now. There's a dozen of the or half a dozen of a very similar, you know, this is our secret sauce. This is our secret sauce. It all comes down to a very similar process. It's just when you introduce reagents to basically drop out the iron or drop out the titanium or drop out the vanadium in a recovery system. So we're the amount of work that has excuse me, the amount of work that has happened on titanium dioxide projects, hard rock projects using chloride leach processes globally has been extensive over the last 2 decades. Now, we took it through pilot plant. We ran a ton of material through this on a 90-day process, and we were very pleased with the results. It was a composite test across our entire lens. So it worked out to over 80% recovery on the material. What we didn't get a good handle on is the lower grade component that sits on top that we hadn't traditionally had in the resource. So that is a piece that we have to go back and work on. Right now, we're using a number of around 50%. We're very confident that we can get it higher, but we can't really get into specifics that until we do some additional work on it. So scaling the technology is we think very feasible based on what we've seen others doing globally here recently, and as well as our metallurgists literally wrote the book on this stuff and teach it at university. It's not necessarily an innovative process, but it's a process that maybe shuffles the pieces around the board a little bit in order to achieve an end result. So we're confident is the short story.
Yeah, that's the answer. Well, I was going to say, so you can basically answer this in a couple of words of being you're confident. But and where I'm coming with all of this is that I just pulled up the news release from EPA that I'm looking at here. You also mentioned that you're now counting what was previously pre-strip waste rock. You're not counting it as ore. How come? Like, what's the difference between now and then? Does it have something to do with this technology that you're talking about here?
Well, we actually went to the metallurgists, and we were showing them the model and running through it, and they flat out said, "Why aren't we including this rind that sits on top? It's it's a couple of 100 meters of material," and they said, we can work with that. That's material that we've worked with extensively in our testing, and you should be including that. And so we historically that wasn't included, but at the urging of the resource estimator and of the metallurgists, we included it because there is recoverable metal from it now. So it basically we make money from surface rather than having to strip back several 100 meters of material. Even though we do daylight off to the west, it's just better to make money from the material you're moving than to just strip it off and move it to the side. So there's probably some blending opportunities, but that's something that we're going to have to establish during our pre-feasibility study.
Okay. Was that what was that going to do for you in terms of numbers? Like, is the pre-feasibility study going to be what 20% less than the PEA, or is there an assumption you're working with there?
I mean, with a PEA, you're basically plus or minus 50%, right? There's a wide range in there. We think, we used pretty conservative numbers as far as titanium dioxide sale price went in our PEA. We beefed up our capex and sustaining capex pretty considerably in there, and kept our opex quite high. Just excuse me, in order to give that buffer. So when we did go into the pre-fees, it wasn't a dream sheet, but it was more based in reality, and especially with inflation going the way it is right now. Everything's getting more expensive, and it's getting harder out there. Let's face it.
Hmm.
So if we lose 20%, if we lose 30% of the, maybe we gain 20%, maybe we gain 30%. It's we're working within sort of established engineering parameters right now, so it's probably not particularly prudent to kind of predict one way or another at this stage.
Well, when are you going to have a definitive answer? Like, when do you expect to have the PFS out?
PFS, we'd anticipate in probably 24 to 30 months from now.
That's a long period, relatively.
Yes.
How come? I mean, is it a lot of work, financing? Like, what's the bottleneck?
Probably. So about, kind of the various financing levels we need to deal with in there. There's probably 6 months of financing work to do in various tranches. On top of that, it's a pre-feasibility study is a significant amount of work. We need to do some additional drilling to move the resource from inferred to measured and indicated. We need to do some additional met work. Engineering takes an extensive amount of time, tightening up the engineering to a point where we can sort of be in the plus or minus 15 to 20%. Is Wildlife studies, environmental baseline work. You can't environmental baseline work is an extensive process, and it's established process. You can't just sort of flip the switch and say it's done. We want to make sure that this is a comprehensive document in order to make sure that we can bring a partner in or sell the project at the end of the day. We don't want to sort of do it halfway and have to go back or lose value on it.
Okay. What I'm just also thinking, like, because you said you're communicating more to the market. What what do you communicate to the market about if you're just because this is a boring engineering phase, like it's called the on the Lassonde curve, so it's not particularly interesting to talk about it to investors. So what do you talk about?
So I mean, it is talking about the value of the project as it sits today, based on our initial document here. It's getting us, hopefully a bit of a revalue in the market with that initial document. Um, Secondarily, we'll be advancing the La Brule project at the same time, so we'll be able to keep news flow happening as we advance that project, and to keep excitement around the company while we're doing all the boring engineering stuff in the background.
Okay. How much money is going to go into the PFS for
Uh,
that
we, we
24 months?
anticipate we anticipate broad numbers right now, someplace between 25 and $30 million, and that includes environmental baseline work.
Right. Is that front-ended, back-ended? When's the majority of the spend going to occur?
Mid to back end of the process is when a lot of the capital will be spent. Early pieces of it is a lot of planning, a lot of desktop studies, tightening up what we're going to do to finalize it. There is about 5 million we'll have to spend on drilling, and that'll be front end loaded, hopefully in the fall this year, and move forward from that into the balance of the studies.
Okay. And I want to ask about how much money it's going to cost you. Well, yeah, let's maybe start there. How much money is it going to cost you to bring Lac Brûle to PEA stage?
We anticipate another three-ish, 2.5 to 3 million. We want to do a drill program on there, tighten up the lenses a little bit. And unfortunately, drilling has got a lot more expensive over the last few years. So that's where the primary spend is on La Brûle. But it 5 to 10,000 meters would be what we need on there, and PEA itself probably someplace in the 300 to 350,000 range, and some network probably.
Okay. When do you want to have that out by again?
We'd like to be able to do the PEA by this time next year on La Brule, and I think that's a kind of a pretty conservative timeline if we do push that button and move it forward.
Okay. Well, I'm also wondering, um, why? As in, I mean, if the market is not giving you any value for one high NPV, high capex project in a PEA stage, why do you think the market will give you value for two of those? And why do you want to do it now and then go and talk to people about it?
I think the market is starting to give us value, albeit slowly. It's a tough market out there right now, in my opinion, but it is turning around. So we haven't talked again. You know, we're in the first few months of coming back to the market and talking about about the project now that we have a PEA out. We didn't talk to the market for over 2.5 years. Really, it was just maintenance news releases, no marketing, no doing what we're doing here, diving into the projects. So it is truly starting to, you basically have a slightly over shell value company with a major project in it now. We have something to grow into. With the La Brule project, I think around, showing some news release, and, some advancement of the project, staged advancement, we'll be able to keep engaged with the market and continue talking to them. And it'll make a higher grade project, in our opinion, based on what we've seen from historic drilling in there. And it'll probably even out to a little bit.
Okay. How big do you think that PEA is going to get? I mean, you probably, are you guiding any numbers publicly?
We don't. We wouldn't be. It wouldn't be prudent to guide publicly on that right now. There's a lot of work to do on it with the drilling. Yeah, we're being pretty tight-lipped about it right now, but we think that it's an excellent development opportunity.
Okay. Well, but there's historic drilling on it. Is there a resource on it that you have in your possession?
There's a historic resource on it. We're not super enthralled with that resource. We don't think the resource was calculated very well. We've audited the drilling. Drilling was done very well. The placement of the drill holes was done very well. The logging of the core was done exceptionally well. The assays, audited the assay work, all exceptionally done. Very, very tight parameters around that. It's just the way they built the block model. We're not very confident in that. So we're in discussions with a couple of engineering firms right now, just around recommendations around where to place the next drilling in order to get the best result and tighten up those lenses to a point where a new resource calculation can be digested by the market, and we have confidence in.
Okay. Well, so how much money do you have right now again, if you remind me?
We've got just shy of $1 million in the till right now.
How much are you budgeting for G&A between now and the end of the PE, which you said is about 12 months?
Yeah. So we're actually going to be in a ramp up phase coming right now, adding additional team members. We need to add engineering staff. We need to add some additional geologists as part of that whole PEA and pre-feasibility work. So as you stated before, we're someplace between 63 and 100,000. We'll anticipate that getting a fair bit higher, 150 probably in that range there, maybe a bit more, just as we add staff and ramp up in order to execute on our plans here. But that's going to be staged appropriately, not all at once. So it's a bit of a moving target right now, but can't build a company without the staff, unfortunately. I mean, we could pay consultants, but they're really expensive.
Right. No, it is true. But basically the money you have right now is covering G&A for you before the PA. So all the money that you're going to need to get to the PA at Lac-Brûle, you're going to have to raise.
We are going to do an additional raise at some point here. And that's always been in the plans, a drilling raise over the next few months, probably late summer, early fall.
Okay. Yeah, and then by that point you're planning more marketing, so you're hoping to do it at higher prices. I assume
Exactly.
that's what you're
Right
after.
now, our primary focus is reducing cost of capital in the company.
Hmm.
So that's it's a bit of a it's a bit of a again, we're coming back to, we're slightly over a shell value from a market cap perspective with a major asset. We want to sort of narrow that dichotomy a little bit, and hopefully, fingers crossed, we do a reasonably okay job. We can again reduce that cost of capital in order to enhance the value even more.
Hmm. Okay. Well, what are you planning for marketing? How do you tell the story? Going to conferences? What else are you doing?
Yeah, so going to conferences is a major piece. We are very bullish on the retail sector right now. It's That's what we need into the company is lots of small and mid-sized shareholders, and connecting with people that we haven't seen in person for ages. We're going out to our networks to reintroduce the story or introduce it to the first time. Between Europe, between North America, some work down in Australia right now. We've got a lot of shareholders that we've worked with on other companies in those jurisdictions, and we think that this is an exceptional opportunity for them to get involved in. Uh, Outside of in-person marketing, I'll note that we'll be in Quebec City here next week as well, which I'm pretty excited about, talking to the Quebec market. We're doing a lot of sort of online work, webinars, some online marketing, getting the story out there, and just introducing it to a broader audience. But a lot of in person and stuff like this, where interviews and whatnot.
Good. Okay. Well, it's making sense. I think I'm wrapping my head around as to how you want to try and unlock this value. Hopefully, there's going to be more updates in the meantime. Anything else that you're planning? Like I believe I saw somewhere in your online communication that you mentioned something along the lines of still expanding the portfolio and looking for other opportunities. Is that kind of a generic thing that every company says, or is there a particular thing in place?
Pretty generic line that every company says. If the right opportunity comes along, we'll take a look at it. At this stage, I would say it's mostly focused on the existing portfolio. If something compelling comes along that is near at hand or adjacent to the existing portfolio, we'll absolutely take a look at it. We don't want to go too far afield, though. We don't want something over here and something over here. It just focus and concentrate, focus and concentrate. What we are doing, though, is we're actively uh, bringing third parties in to test our technology suite.
Hmm.
We're in active discussions with a number of groups right now for them to run pilots or run desktop or sorry bench scale and deploy it onto their projects. It's that's a starting to become a piece of business in the background. I'm not talking about it a whole lot yet, but that is sort of that is a push for us right now. But focus on our current projects is the key takeaway from that.
Good. Okay. What am I forgetting to ask you? I've been through most of the stuff that I wanted to ask you. I think you've told me a lot more than that as well, so I appreciate the overview. What did you come here hoping to talk about, though, that I'm not bringing up?
Well, I think we've covered it really nicely. I just want to say that I think that there's a really good opportunity around value of the asset versus value of the company. We got to narrow that gap right now, and I think there's a lot of opportunity for people to get involved and hopefully experience a good appreciation of capital in there. And I'm really excited about this company. Is the gist of it.
Right. Well, again, Kyle, it's not going to be easy. I'd be happy to follow along and see what you make out of this. Good luck, and thank you again for the overview and doing this. I appreciate you investing your time in me. I'll let you drop off now, though, as I am moving to the last CEO barbecue for this week. And well, everyone sees who's sitting on the other end of this Zoom call, so I'm not going to waste your time on introductions because it's not every day I get to speak to the person running a company that owns supposedly one of the best undeveloped ore bodies of any commodity, but definitely in the uranium world. In the world. And first of all, Lee, thank you for investing your time in me. I like that background of yours, and I am looking forward to chatting.
Oh, great to be on the show.
Pleasure is all mine, of course. And you know, most people have no backgrounds, or they have these corporate backgrounds, which I typically don't like. So I'm not just saying that. Anyways, there's a ton of things to talk about here, and I guess as the CEO barbecue is warming up, as I like calling it, let's maybe start you off lightly with this week's news release out of NexGen. We basically found more uranium along the Patterson Lake corridor. I guess no surprise there. The grades don't look too crazy as of yet, but they're good. So feel free to talk to me about that, but mostly maybe talk to me about the why behind your exploration program as a whole. I mean, it's not like you need more uranium, right? So why do this?
Sure. Well, look, we went to a brand new part of the Athabasca Basin back in 2013, and that land package that NexGen hosts on the Rook I property had never had a drill hole on it for over 30 years. And we found Arrow back in 2014, Valentine's Day, in fact, in 2014, with the very first drill hole within a 4.5 kilometer radius. And it was the 21st drill hole ever on the property. And we ended up, Arrow then turned into what is the world's largest, highest grade uranium project. Phenomenal size, grade, but also in the basement rock, which gives it an elite environmental and technical setting. And as you alluded to earlier, it's a real unicorn and the best out there, probably one of the best economically in resources, full stop, from an internal rate of return perspective when in production. But I always said, look, obviously we know what we're doing geologically, but the probability of us finding the only world-class ore body on that property in such a short number of holes ever drilled on the property, given the size of the project, it was obviously probable that it was one of a number of uranium occurrences on that package. And so we then set out, now that we're so advanced on the permitting and the engineering, to start re-engaging the geology team to seek what is the true extent of mineralization on that Rook I property. And there's no doubt there's been a very significant mineralizing event in the area. We'll also have Triple R just down 7 kilometers down the conductor corridor as well. And so there's been a very significant mineralizing event in the area. We are right on the edge of the Athabasca Basin with an enormous number of conductors. And for the audience out there, conductors are typically the cracks in the ground where the uranium-bearing fluids have moved through. And so we know there's a strong presence of those conductors. We know there was a significant mineralizing event in the area, and it's completely untested. And so we've looked for similar signatures to Arrow geophysically, and then with the drill bit. And lo and behold, 3.5 kilometers due east of Arrow on a completely separate conductor corridor, we've discovered mineralization. Now, to put that into context, as we speak, the hole at 183 that we announced recently, from an assay perspective, is significantly better than the discovery hole at Arrow. Further, the other holes that we have drilled, and we've hit mineralization again, 275 meters along strike from the 183 discovery hole in this new Patterson corridor east, has validated that we're onto a significant system. And so to put it into context, how excited are we about this new discovery? Well, at the same time as Arrow, this discovery at PCE is looking far more prospective based on the information and the facts that we have today. Now, Arrow, it wasn't until the 30th hole and the 60th hole that we started to really zap high-grade mineralization, and then we started to get a good appreciation of what Arrow is. Arrow developed very, very quickly. There's no doubt about it. They were all developed, these deposits all develop in their own time. Now, we may unlock it earlier than 30 to 60 holes. It might take a few more holes. But as we stand and speak today, if you had to choose between the Arrow prospect at the same time and this prospect at the same time, I would suggest strongly that the majority of geologists would be taking this Patterson Corridor East new discovery to sink the drill bit into. So Yeah, it's an incredible time for us because we are developing the world's best uranium project. And at the same time, we could be on the cusp of another one. And every indication today looks as though we're onto something of a similar magnitude, perhaps potentially bigger than what we have at Arrow. And look, that's just why are we doing it now? One, we're advanced on the engineering and the permitting at Arrow. It's freed up the geological team to get back and explore. And we've learned a lot. We've had 400,000 meters drilled at Arrow. We've got a really good understanding and a really good foundation to go and find additional arrows, and they clearly exist. So it's really exciting to have that running in the background as we advance the final permitting of the Rook I project.
Well, but this looks a bit different than Arrow, though, relative to what you were drilling at Arrow at the beginning, right? Because it's kind of more disseminated. You're hitting stuff that is a little bit closer to surface than what you started hitting at Arrow and stuff like that. So, but anyways, it'd be interesting to see how you develop that over time. But what you're mentioning here, you said at the beginning, we know what we're doing, referring to the geological team behind it. But the we of it all, the composition of the we has actually changed because this came on the back of your vice president of exploration, Gareth, who was with you since the early days of discovering that Arrow, leaving the company. But I mean, there wasn't much information in that news release that waved them goodbye to go on. So yeah, what happened there? I mean, why is Gareth leaving?
No, well, just to clarify there, and this is verifiable from the news releases, it was actually Andrew Brown, who was our vice president of exploration during the discovery of Arrow. Garrett Ainsworth came after the discovery, contributed to the defining the mineralization at Arrow post discovery, and Garrett left back in 2018. The DNA and approach to discovering mineralization wasn't just Andrew Brown, myself, and a number of geologists. We were also referring to all the work that had been done 30 years prior, and in and around the project. So yeah, the discovery of Arrow is, as I said during our PDAC acceptance speech for the Discovery Award, is a function of many people's efforts over a long period of time. And that approach that NexGen has implemented towards discovering what could be there, as opposed to what has been discovered in the past, is the DNA of the company's approach to exploration. And there's many people responsible for these discoveries. Every geologist that's been with the company has contributed. And but it's the same DNA, the same process of mineral discovery that led to Arrow is leading to this discovery. And at the same time, this new discovery, given the amount of drilling that has occurred, is looking far more prospective than what we saw at Arrow at the same time.
Okay, fair enough. Basically, thinking or leading up to what I want to talk about here is part of the compensation behind these things, and just wondering whether there are any disagreements happening when people leave the company, or where that stems from. And where I'm coming from with that is that one of the main topics of discussion has been sort of the size of your G&A, which you have been asked about before, but it's also worth repeating, as I suppose it's going to set the stage for what we'll talk about later on as well. But so you have some of the highest G&A within the non-revenue generating space of the mineral resource realm, as far as I could find. Correct me if that's wrong, of course. But so your marketing spend, for example, is a decent chunk of that, including sponsoring an F1 Formula One team, as well as a hockey team in Vancouver, and a lot of other things, right, that people are talking about. Talk to me about the thinking behind this sort of non-traditional approach to marketing, especially provided that you currently don't have a product to sell. So like, why does it make sense for you to put your logo on the nose of an F1 car, or on the helmet of the Vancouver Canucks? So yeah, talk to me about that.
Yeah, well, first of all, let's talk about the philosophy of how we decide to spend a dollar, whether it be at G&A, be it partnering with Aston Martin, the Canucks, or the Saskatchewan Roughriders, or putting dollars in the ground. We have the lowest general and administrative expense per pound of mineralization ever discovered for a uranium project over 100 million pounds. But that can be skewed by the grade. So let's look at it in terms of the general administration per meter drilled, irrespective of what you discover. And again, we had the lowest cost of discovery, or the lowest cost drilled per meter drilled, than any other company in our sector. When it comes to general and administrative expense relative to total exploration development spend, we're at about 43 cents per dollar, whereas our peer group is around $3.54. And that's clearly documented in our management information circular. So we purposely analyze those figures and put them out there for everyone to see. Now, with respect to building a company, we are currently at a market capitalization just over 6 billion. We started at zero. Now, since inception, our share price return has been 2,485%. In the last 5 years, it's been 285%. 3 years, 164%, and last year, 55% annual share price growth. So on average, about 55% share price growth annually for the last 5 years. And that's been during a pretty tough market. So with respect to specifically around the partnerships, be it the Rough Riders, be it the Canucks, and let's just start with those two because they're Canadian based. We have purposely done that. And as a consequence, the kids from the local community have had opportunities that they've never had before. We're about building a workforce that is located at the project and basically introducing programs that are about positive mentorship. And it's basically saying to the youth of the local project area that in NexGen, you've got a company that looks out for you career-wise, but also community-wise as well. And there's a reason we enjoy such fantastic support in those local communities, because we're going above and beyond every other company out there in the resources sector with respect to our social engagement. And so that investment, if you like, or you would like to call it, has paid enormous dividends. And with respect to the Canucks, they also travel out to La Loche and also continue that mentorship right throughout the year. So it's an incredible program. No other company does it. And we're fine with that. We're happy to do it. It is incredibly positive. And it's all about building a company and operating a company successfully, which is incorporating not just the technical aspects and the environmental aspects, but also the social aspects as well. And any successful resource company operating today does all three components very, very well. And you're seeing that with the majors like BHP sponsoring women's football in Australia, doing a whole host of community social programs that are not related specifically to mining. And that simply recognizes that mining is far more extensive than just the technical and economic aspects. You need to deliver on all three fronts in order to be a successful mining company. And it really does reflect we're building something real and for the long term. With respect to Aston Martin, the primary driver there was around safety and innovation. And we make no apologies for being one of the most innovative companies in the sector. If we listened and did it like everyone else, we would never have gone to that side of the basin to look for mineralization. At the time we got criticized. Oh, you'll never find mineralization there from some of the majors in the sector. Well, not only did we find mineralization, we found the world's best project. So in terms of the decisions made as to what we do and don't do, we do some aspects which are different to what has occurred in the past, but they are all working, and they're all working in the context of having a very low ratio or low G&A spend relative to exploration and development, and also relative to market cap. With respect to the Aston Martin one, as I said, it was primarily based and is primarily based on safety and innovation. The leading minds, brains in the world, alongside NASA, are in Formula One. And so we are taking those principles and those performance metrics and bringing them to our mine. Our mine will be one of the most technically innovative, efficient mines on the planet, and ultimately safety. And so we want as few people below surface, and we want the interaction between advanced machinery and human interaction to be as safe as possible. A flip side another attribute of that partnership is that it's opened up a whole new investor base to the company as well. And there's a reason why 2 weeks ago, we had hit an all-time high in our share price. We're opening up, we're not just going to traditional mining investors, we're opening up this good news story to a far broader audience. Formula One has 2.3 billion people watching it. And the fact is, we are getting the story of nuclear energy and this exciting story of NexGen to a wider audience. And in terms of relative to peers, our share price performance, as I said, up to the announcement of the uranium purchase, we're leading all the charts in terms of year to date, 1 year rolling. And at the same time, we've dealt with a block of 70 million shares, or approximately 18% of the company since September of last year, being disposed of. In that time, we've also raised over $500 million. And yet we're still leading share price performance, even with all these aspects. So the partnerships are dual focused, they're socially focused, they're technology focused, safety focused, and also commercially focused in broadening the audience looking at the space. And now that has to be in the interests of all existing shareholders, that we are finding new shareholders. We've also done the same by coming to the ASX, opening up a new market so they can access this tremendous story in NexGen. And it's working by virtue of all the facts around share price performance and audited financials that clearly and transparently convey what our cost structures are. And then in our MIC, we purposely put out the information there relative to our peers for everyone to make an informed assessment.
I do want to talk about that.
And on the facts, we lead all the tables in terms of efficient use of capital, but also share price performance relative to our peers over not just the short term, but also the medium term and the long term.
You mentioning your peers here, and I do want to talk about that just in a second here. But I also wonder at the same time, because you are good at finding uranium, you've proven that, and your stock price is going up. I can appreciate that as well. But I wonder whether your stock price going up is related to F1 and hockey, or is it related to finding one of the best undeveloped ore bodies? And I wonder whether putting the capital in F1 is better than putting it in more exploration, like you mentioned at the beginning. So how do you weigh that? I mean, knowing that you're good at, you have proof that you're good at finding uranium. You don't necessarily have proof that you're good at making the stock price go up because of F1. So how do you make that decision?
Well, as I said, it's a number of factors. It's around, if it's F1, it's around safety, innovation, and also opening up the story to many, many people. I think, yeah, you're saying that the stock's going up just because it's a fantastic deposit. Yes, that's part of it. There's also a rising uranium price. We're doing a number of things that are very, very attractive and getting the story out there to a broader audience. And the share price is responding to all of those initiatives, not just drilling, not just federal approval advancement, engineering advancement, all those factors. And so, look, as I said, we own the fact that we're doing some things differently, and the share price performance is performing extremely well relative to our peers, and we're doing it at the most efficient use of capital that's ever been seen in the sector. So I think that speaks for itself. The information's all out there for people to assess, and I think it speaks for itself.
I think a lot of the discontent around this, or where I found this from, was, yeah, mostly just discontent online, if you will, is sort of around paying attention to, oh, is management overcompensating itself, as in they're just doing this F1 thing to get, you know, a VIP seat or to get a VIP box to watch the Canucks and stuff like that. Do you get VIP spots, and what do you say to that discontent?
Well, I personally, I didn't go to a Canucks game all season. Did I go to yes, I've been to an F1 event. Of course I am. I'm meeting new investors at that event. In total, I'll go to 3 this year. You know, I understand being the leader in the industry puts a target on your back. That's fine. And you should be asking these questions and getting the facts. And I am presenting the facts. Look, you're always going to have a target on your back when you're leading. We're not surprised by it. We're not intimidated by it. We are making decisions based on the interest of our shareholders. And look, I think our shareholder base and the quality of our shareholder base reflects that. We have always had, like, the top end of the industry in terms of fund management invested in our stock. And a lot of the time, Li Ka-shing, he invested into the stock, or wanted to, prior to us even having a resource. So we have very strong traction with the top end of town in terms of fund management, because we are very transparent in our disclosure around our approach, our decision-making, and the incorporation of the most efficient use of capital. And as I said, audited financials are there for everyone to see. Our share price performance is there for everyone to see, and it's there for everyone to see against our peers. And we have, as I said, I don't think there's a metric that we're not at the top of the table on any of those fronts. So yeah, I totally own we're doing things differently. We're not apologizing for being innovative, exploring new markets, and it's more than just developing a project technically. Today's day and age in mining, you've got to do more than that. And I guess there's also a reason with our approach, or a consequence of our approach, it's led to us getting the first permit in over 20 years provincially. It's also the most efficient permit in terms of cost and time in receiving a provincial approval for a uranium project as well. So, you know, those who are maybe envious of our performance, you know, some choose to criticize it and look to twist the facts in order to generate a certain narrative. I can tell you, I don't spend any time on it. It doesn't influence our decision making. We would rather have our share price performance and our audited financials as the judge of our performance.
And performance is relative, as you mentioned. So you have a peer group, the companies that you compare yourself to. I suppose executive compensation, when I just brought up, is also sort of you're using a peer group comparison to come up with that. What I do wonder about is that the names you mentioned there, they are mining companies, whereas you're not yet a mining company, you're a development company. So they're revenue generating companies. I think Cameco's in there and other companies in it. So how does that make sense for you? How did you come up with that decision to compare yourself with revenue generating companies when you're not one?
Well, we're comparing ourselves to revenue generating and also development companies in that assessment. Now, as I said, every decision around pay is in the context of the overall general administrative expense relative to the overall exploration development spend, relative to the market capitalization of the company. We also have the highest market cap for a resources company not in production as well. So very, very clear about that. With respect to my salary, I'm on about a third of that, of those producing companies, of those CEOs that are running producing companies, which will be in 4 to 5 years. I can tell you there's far more work involved in establishing a company, building a team, permitting a project, running the engineering, and negotiating sales contracts than what it is for a steady state operating company. And so, yeah, I'm on a third on average relative to those producers. So, look, there's no doubt we pay in the top quartile on a comparative basis to companies in our peer group, but we're seeking the best of the best. This project deserves the best of the best, and coming to NexGen, you have to give your best. Now, I would also convey that if you look at the head, the number of people involved relative to other organisations in G&A, we have a much lower headcount than what those other companies do on a dollar basis. So you've got to look at it in totality in terms of what's the overall cost, how many employees, what's been the return on the money that has been spent, and overall share return, the share price performance. So as I said, all the information's there, and it's fully transparent. So yeah, we want the best involved at NexGen. We have a fantastic team, and they are delivering on every front. So yeah, it is very, very transparent.
You want the best involved. Everybody does, including my wife, even though she's not always going to get him. But anyways, well, what I saw starting to happen this year in your attempts to attract the best here is you're using RSUs, DSUs, stuff like that. A little bit technical, complicated ways, I suppose, to compensate management and staff. So you're using them as part of that compensation package too. But after listening to an interview with you last year, but it must have been a conference call or something along those lines, I was under the impression that the board was not a fan of those before getting into production, before starting to actually generate that revenue. Did something change, and why the decision to go for RSUs instead of like future vested options?
No, we haven't issued any DSUs or PSUs to date. Okay. We have used options in the past, continue to use options.
But so no RSUs or DSUs planned, or
not at this stage.
Okay.
And I'll explain the rationale. We have granted options along the way to incentivize staff. Those options have also always been issued at a price higher than the previous capital raise price, and they've got 5-year expiries, and they are only result in realized gain to the recipient if the share price is higher in the 60th month after grant. Now, at the same time, so they are worth nothing unless the share price has grown has grown and all shareholders have won. And the price for employees has always been higher than the previous capital raise that we've done. With respect to, and as a company who's in development, non-cash, as you stated before, we believe it's more prudent to incentivize that way, as opposed to using the company's treasury to buy shares for its employees, irrespective of performance. Look, that is the way to go. As the company transitions towards development and production, yeah, the application of DSUs and PSUs become more relevant. But I don't know one shareholder out there who would be advocating using the company's treasury in a non-revenue generating company to buy the staff shares irrespective of performance. That makes no sense. So that is why we use options, but we are forecasting as we move towards production and cash flow, the application of DSUs and PSUs will become more appropriate at that time. And that's just purely incorporating preserving as much cash as possible and putting as much cash in the ground as possible. And when the options are exercised, the employee has to pay the grant price, which was higher than what investors did 5 years previously.
I agree. It makes no sense to, well, in my opinion, it makes no sense to do RSUs or DSUs, and especially not if they're immediately vested. That's why I'm coming from with these questions. So I'm happy to get that answer, that's not what's happening. Options, I don't think anybody's complaining about options. You incentivize your people by giving them a bunch of options.
Yeah, but with respect, yeah, you mentioned like my salary in the disclosures, it incorporates Black-Scholes valuation of those options that have been granted. That is non-cash. I don't see a cent of that unless in the 60th month, the share price is far higher than what they were granted at 5 years previously. So I think that's a bit of an anomaly with respect to financial reporting and people see, yeah, I think it's stated in 2021, I had a salary of $21 million. I did not receive $21 million. That was a Black-Scholes valuation on the options granted as a result that we'd had a rising share price. So the higher the share price rises, the higher the valuation, yet it resulted in not 1 cent with respect to that option grant. So I think that's a bit of a anomaly in reporting. As a non-revenue generating company, the focus has to be on cash expended and cash realized in terms of making an informed assessment as to whether someone has high G&A or not. And with respect to our G&A, we have very large non-cash items in our expense column, which have a non-cash. They're accounting estimates as per the International Financial Reporting Standards.
You say not 1 cent, but that's not, I mean, there is a cash component to your salary, right?
Yeah, there is a cash component to my salary. There's a base plus performance. Performance is based on meeting certain milestones. I'm talking in terms of the option grant gets assessed a value, which is then disclosed as remuneration. The option value of those grants, I do not receive 1 cent unless in 5 years' time the share price is higher than what those options were granted at.
Okay. Well, what percentage of that is it? Like, what percentage of the $21 million is on that base?
That year, I think I got less than 10%. I think I earned about $2 million that year, because we had a year of meeting milestones around securing impact benefit agreements and engineering milestones.
Good. Yeah, thank you.
Which my performance or criteria is fully disclosed in the MIC.
Thank you for that answer. I hope I'm not being too forward with these things.
I'm totally happy for you to ask any question to help clarify or help investors out there with digesting the facts, as opposed to some of the false misconceptions that are generated on social media.
Yeah. Well, there's a whole bunch of that happening all the time. As someone who spends most of my day on there.
And Tony, I think it's coincident with the fact that we're approaching federal permitting. We are getting very, very close to a very major milestone in the company's history. It'll be a significant value generator, and there's more eyes. And as I said, when you're leading the sector in many, many fields, it naturally puts a target on your back. And I get that. But look, I'm accountable to our shareholders. The board's accountable. Everyone at NexGen's accountable. And this is an opportunity. All the facts are out there. It's very, very transparent. It's audited. And it's a good news story in a tough environment. And even those people who want to complain about whether someone's on more salary than them, whatever, they've still got an opportunity to look at the facts and make an informed assessment as to whether they would like to become a shareholder or not, or increase their shareholding.
You are indeed moving towards permitting here, which is something I want to talk about, because it's going to be a big influence on that timeline that you just mentioned, 4 to 5 years on here. And I want to sort of deconstruct everything that has to happen between now and 4 to 5 years to see how you're progressing on that timeline. And as far as I understand it, and so I'm starting it at sort of the everything basically. But as far as I understand it, the idea is to go for long hole stoping mining method, right? Or are there other techniques being considered too, where maybe it's a close call between this and the other ones that are considered, or like or are you set on one?
No, look, our mine's very, very simple. It's incompetent basement rock. It's got exceptionally clean metallurgy. The mining method has been consistent from the very first engineering study back in 2017 in the preliminary economic assessment. Then we had a pre-feasibility study in 2018 and the feasibility study in 2021. The mining method has been consistent right throughout. As I said, we have a very simple ore body. In competent basement rock, we'll be employing, it's a very conventional mining method and then processing method at surface. So, we're moving on average the ore volume of 1.5 double-decker buses a day. It's going to be one of the world's tiniest mines, yet produce about 25% of the world's primary mine supply based on 2023 mine supply figures. That's a function of its grade. It's incredibly high grade, but it's also in an incredibly sound technical setting as well. So it is a complete unicorn from a resources sense, and the mining method and the processing method is very, very simple. Now, we've taken the opportunity to also incorporate, best practice when it comes to tailings management. And we are spending extra money in order to store the tailings underground. And now that is elite environmental approach. And it's something that ourselves, the government of Saskatchewan and the local communities have all supported very, very strongly.
I'm probably the furthest thing from a mining engineer that you're going to meet in a long time. But is there any, given that that is the fact, and so the reason why you can move that little dirt and get so much uranium out of it is the high grade, right? So is there a risk of radiation exposure for the staff of the mine, given the high grades combined with this mining method?
No, look, there's a lot of risks in mining, but these high grades in the Athabasca Basin have been around for the 30 years. They're dealing with similar grades at MacArthur River and Cigar Lake, and so the same procedures, etc., will be in place with respect to Rook 1, but we're even going further by our philosophy or approach to keep as fewer people or to have as many people above ground as possible at all times, in order to go even further with respect to the safety of our team.
Are you doing any additional test work before building the mine in that case? Because again, not a low capex, so you wouldn't want anything that big to go wrong before the money or after the money has been spent. So are you doing anything before you do the capex?
Yeah, look, we've done incredible number of studies they date back to 2014. We are in the final stages. Any changes at the moment are incredibly immaterial, and they're really some fine tuning around the edges. I don't think there's any project in the world that has been thoroughly tested more so than Rook 1 prior to the commencement of construction. The other aspect too is that we've drilled this ore body out on predominantly a 9-meter centers. We have a very good understanding of the ground conditions. We have a very good understanding of the continuity of the ore, and metallurgically we've tested this a number of times, and frankly we can't test it any further prior to actual construction and operation. But look, I'm a chartered accountant. I'm inherently conservative. The value of our asset is based on the quality of the data, and we're well recognized in the industry for having the most elite QA QC around every aspect of this project. So ourselves, investors, the community, the government have a lot of confidence with respect to what's about to occur with respect to construction. And as I said, in a mining sense, on the simplicity scale, it's one of the simplest underground mines that I'm aware of.
Is that within uranium or just generally? Because as far as I understand, I mean, having the higher grade and having the risk to radiation exposure does make it more complicated, and it requires a better trained workforce and stuff like that. Is that the case?
Yeah, it's more complicated, but it's within a context. And to put it in perspective, a international airline pilot flying between New York and London over the course of the year will receive more radiation than one of our guys or girls working underground. So it's very well regulated, as it should be, but it's also very well understood. And all of our procedures and the monitoring, etc., Like we're dealing with that now. When you bring ore to surface and you've got 80% grades, like those policies and procedures are in place today. And we have an outstanding record with respect to our health and safety management.
You're mentioning regulators, and that's also something I was thinking about, is that like if I'm coming across this chatter, the regulators would have thought about it too. Is this approach making it tougher to get regulatory approved? Like, are they asking more questions? Is it taking longer, which is the main thing we're talking about here?
I don't think it's taken longer. The provincial approval for our project was the most time efficient in history. I think that's not just the way we went about approaching the permitting process, but I think it's also a function of the technical and environmental simplicity of our mine relative to others. We're in the final stages of the federal permitting process. We responded to the remaining 49 aspects just last week. And that was really clarification of those questions to provide some further information or clarification around that approach. Now, we are very confident at the end of this 90-day review period by the federal government that our EIS will be sufficiently advanced to be deemed final. And if there's anything remaining, we will address it. And we very much look forward to that that conclusion of that process. And so, yeah, it's a very exciting time for us in terms of our company stage of development, and we're on the cusp of that permitting finalization, and then we're immediately into construction literally the very next week.
I know you're not hoping for it, and I understand that you're saying the probability is high that you're going to get that permitting, but I've seen stranger things happen, and so I'm thinking about the what if. Like, well, what's the plan for dealing with the situation if the CNSC denies a permit, or any of these or any of the other permits get denied? What's the plan for dealing with that?
Well, if there was that situation, there would have to be a validation of why it is denied. Now, we have met every environmental, technical, and social aspect. We also have a provincial government has approved our environmental assessment. The 4 communities have all signed impact benefit agreements and lodged letters with the CNSC advocating approval of the project. I would say that is pretty thorough. And I don't foresee any aspect that would deny approval of the project. If it was, it would need to be validated. And as I said, EIS has already been approved provincially. It's gone through a very thorough, rigorous process with all the communities. They have signed off on it and endorsed it to the CNSC. So I can tell you, I am not concerned of a potential denial at all. If there's something to resolve, we will resolve it. This is an environmentally elite project, socially elite, economically elite, and it has approval already from a number of very key stakeholders. So I don't see a scenario where it's denied. It's just really a question of when it is deemed, the EIS is deemed final, and then followed by a commission hearing date, and then subsequent approval within 60 days following the hearing date.
Well, what do you think of some of your, well, at least one of your peers that I'm aware of in the basin close to you as well, who doesn't have to go for the federal approval because they're working under the IAA of 2019 instead of CEAA of 2012? Is that something that would be available for you? And if it's not, I mean, what are your general thoughts on that?
No, look, we chose to go under the dual provincial and federal approval, and under CEA 2012, and we've done so. We've also incorporated in many aspects that new legislation as well with respect to our approach and our substantiation of the operation of the project during production. So whether someone else chooses to do it differently, they're making those decisions. We chose a path that we felt was right given our asset and our circumstances, and we've been very, very pleased with that. It's a very thorough process. We are at the conclusion or near the conclusion of it, respecting that there's 49 aspects to conclude. And we've had a sensational experience with both the provincial Ministry of Environment and also the CNSC. It is a good news story with respect to the resources sector, and we look forward to this process concluding, and then going immediately into constructions, followed by operation 40 months from the commencement of that.
Why I'm asking this is because of timelines, of course, because that other company that I'm referring to here supposedly is going to have shorter timeline permitting under that 2019, under not having to do the federal thing. And I've also just tried looking into normal timeframes for permitting overall. And so if everything goes as planned and there's nothing there's nothing too specific that I could get my hands on, but if everything goes as planned, I was reading about 24 to 36 months seems to be sort of the internet wisdom, if you will, for that permitting time frame. Is that a reasonable time frame for permitting if everything goes as planned, 24 to 36 months?
From when? From now?
Yes.
No, as I said, the 90-day review period of these remaining 49 aspects will conclude. We submitted that last week, so about 83 days from now. We'll have an answer from the CNSC, and then there'll be a commission hearing date set. Now, we have full support from the provincial government and the communities in the local project area. I see no reason why that commission hearing date needs an extensive period of time. I'm informed that it would be 3 to 6 months notice from the EIS being deemed final, which could be the case within 83 days from now. I can't comment on where people have got 24 to 36 months on. I'm just communicating the facts as I know it, and they've been conveyed to me from the regulatory bodies.
Maybe it's just the entire process that takes 24 months or something like that, like from the beginning, not from now for you.
Well, we commenced back in with the project description. We lodged that in April of 2019. So we're actually approaching the 6th year of the process formally commencing. And that's incorporating information dating right back to 2013. So I don't know what you're referring to or what these other companies are referring to, but it's kind of irrelevant. What's relevant is we're in the final 90 days of the final 49 aspects to conclude, and we're very confident regarding our submission with respect to those 49 aspects.
What happens after that, specifically, as in you send in your response now sometime, let's say towards the end of this summer, what happens after that?
We've already sent in our responses last week.
Okay. So what happens then?
We will receive feedback from the CNSC 90 days time. And we're very confident around the answers that we've provided for these 49 aspects. We, without being presumptive, we would expect that EIS at the conclusion of that, subject to us satisfying the CNSC's requirements, will deem that EIS final. They will then set a commission hearing date, and the project will receive environmental approval at that time federally.
Okay, so it's basically that by the end of the summer timeframe that I'm thinking about is when you get that response, not when you send it in. And then what happens after that? When you, in terms of permitting, everything is done, you can go and look for financing, or are there any other permits that you have to go for?
No, the key permit is environmental approval, both provincially, which we already have, and then federal environmental approval, which we're in the very final stages of concluding. After that, there's administrative licenses, etc., which have been submitted, and we would, for all intents and purposes, be able to commence construction literally the weeks following environmental approval by the federal government.
There's no, what I'm really asking about is hidden permits or something along those lines, like, I don't know, communities, fishes, birds, something, whatever that I might be missing, something that I'm not aware based on desktop studies.
It's more extensive than desktop studies. We have fulfilled all requirements by the CNSC, subject to their final review of these 49 aspects. The communities have signed off on every aspect of the project through to closure. Look, we understand what we're doing intimately. We are very, very confident that we'll be receiving federal approval in the very near future, having satisfied all those requirements. So we've tested the project thoroughly on all fronts. We've engaged with all stakeholders on all fronts. We have full support from those stakeholders, and we're in the final stages of the final one with the federal government. So that's where we're at with it.
And I know in the meantime, you're also doing work towards the financing part of it all that I just mentioned. You have some, I don't know if I should call them agreements or not in place, but there's, I mean, you have at least verbal agreements in place. Is the type of financing that you're going to go for dependent on the permitting decision, or are you already sure on how you're going to finance this whole thing?
We've been working on the financing aspect of this for over 2 years. We've been running an extensive due diligence process with interested lenders. Their expressions of interest, which are formal, are currently at about 1.4 billion US. We currently have $930 million between cash and liquid assets on our balance sheet. And so with those two combined, we have more than sufficient capital to construct this project subject to approval. Those, with respect to the debt, are ongoing. And really the timing around concluding that is on receiving federal approval, because we can't actually start construction until we have federal approval. So that is really what's dictating time. The longer we have left it, the better terms have become with respect to that debt, because the uranium price is rising, and the project is getting more and more certain as we proceed through the federal permitting process. So the timing is related to those two aspects. As to when we conclude the debt, it will be around the time of receiving federal approval. That is also coincident with our contracting strategy as well. We've been in negotiations with utilities for a number of years. We've been keeping them up to date with the project's progress since 2017. And we're in negotiations with US, European, and Japanese utilities for offtake arrangements as we speak. Now, again, those contracts will likely to conclude maybe just prior or after or at the time of receiving federal approval, and the timeline to production is then very, very certain.
Does the CapEx numbers that you're quoting here, that's inflation adjusted, I assume?
I was quoting the amount of cash that we have on our balance sheet at the moment, plus the debt that we're currently advancing. The CapEx, as per the feasibility study in 2021, showed Canadian $1.3 billion. Inflation adjusted, that 1.3 billion Canadian is 1.62 billion as we speak. And then with respect to the final detailed design, we're looking at approximately another 400 million in the long-term interests of the economics of the project. So we're looking at a CapEx for the project in the vicinity of $2 billion Canadian. Now, at the current spot price, the economics of the project still show a payback period of less than 12 months. So as we mentioned earlier, it's an economic phenom, and the project is quite insensitive to rises in CapEx. And so and then in light of our financial resources that we have now, plus the debt that we're negotiating, we have more than enough runway there to finance the construction of the project.
CapEx is going up. Does that also mean OpEx is going up and that your all-in sustaining cost is also going to be higher?
Yeah, OpEx has gone up as well. Labor component of it has gone up. And look, that's consistent with every mining operation. But again, when you incorporate the increase in OpEx as well, CapEx, but also the commodity price, we have a payback period which is consistent, incorporating a $50 uranium price. It was 11-month payback at the current commodity price of $90 a pound. We're still looking at a less than a 12-month payback period with respect to those updated costs. So you're going to have swings and roundabouts. At $50 a pound, though, this is still one of the best performing assets in the resources, full stop. We'll be generating after-tax cash flow that will take us into the top 10 mining companies worldwide. So, you know, and you're asking a lot of questions from a risk perspective, as you should. The financial risk around this project, the environmental risk around this project, the technical risk around this project, and the social risk around this project is very, very low, given all the work that has been done and is understood by all the key stakeholders.
I suppose that's mostly due to labor, that the OpEx and all sustaining costs are going up. And that's also been a discussion, you know, the shortage of labor, and especially people who are skilled within the uranium space, because we've gone, you know, through a decade of undersupply and an outflow of brain capital out of the sector. Are you already looking for people? Do you have hunters out there for you? How are you going to ensure that you have the right people for this?
Yeah, well, we've been running training programs in the community for over 2 years now. As we've been very, very clear, we're looking about building a workforce that is locally based. People live and work in the area. It's a real strength of our project, and hence the programs that we mentioned before are all contributing to that initiative. The aspect as well, and you want to mention Aston Martin, well, we're attracting the best minds in the industry. They see that we're incorporating elite technology, innovation, and safety. And so we're attracting a very high caliber of people wanting to come to Saskatchewan and work at NexGen for not only the project, but also the incorporation of our philosophies about being elite from a technology, innovation, and safety perspective. And so there's many aspects of that partnership that have had incredible results for the company. And that's one of them. We are attracting the best of the best. We are making a statement. We are going to be the elite in mining when it comes to all aspects. And that's what investors get at NexGen. It's different. We are, as I said, we aren't constrained by how others have done it in the past. We pride ourselves on determining what is optimal and going after it. And we've done that, but in an incredibly cost-conscious manner. We are going to be a top 10 mining company worldwide. We have a very significant project. We are attracting the best staff, the best members to the team. And we are purposely got a target to be the best in everything we do. And to date, we've achieved that. And going into construction and production is going to be no different. It's the same philosophy, the same mindset, the same approach. And what's it generated? Industry record shareholder returns in the process. Which is the ultimate judge.
Yes, over the long run. I would agree with that. Where I'm coming from with that question, with those questions, as we're talking about, we were initially talking about timeline, and we still are, at least in the back of my mind. Where I'm coming from with these CapEx questions, because also I'm wondering whether you're going to have to do another capital raise to go with that financing. Because if, let's say, you're saying CapEx is going to be 2 million, you know, you take some conservativeness to it, 10-20%, whatever it might be. 20 might be too much, but 10%, well, then you're still going to have to raise some more money for G&A and, you know, keeping the advertising and keeping those returns going, as you mentioned. Is that the case? I mean, are you going to have to do another raise?
No, I don't see another raise, a foreseeable raise at the company. We have 930 million in cash and cash equivalents on our balance sheet. we have debt of 1.4 billion under negotiation. That is more than sufficient to construct the mine and get into production based on what we understand are the costs involved. And there's a high level of certainty around that because engineering-wise, we've fully engineered a lot of the early components of mine construction around the surface infrastructure and the underground workings. We're close to appointing a shaft contractor for the project. Now that'll be a fixed priced contract. And so it'll take out the inflationary risks around that. And that is the major component of the whole mine build. So we're in the final stages of this. And we have a high level of certainty around those costs, high level certainty around the debt financeability of the project. And so we don't foresee any future equity raisings based on all those factors.
Okay, so let's just go back to timeline then in that case. You get the permit, you get the financing done. Again, those are ifs and those are the forward-looking statements we always talk about in this industry. But you get that done, you start construction. How long is construction going to take?
40 months. 40.
Okay, 40. Okay.
40. So three years and 3 1/3 years.
Okay. And that starts counting. Yeah, when do you think the final financing package? I mean, the end of this year?
Not
Does that
dependent
sound
on
reasonable?
financing. We have the financing in place as we speak. We've already put deposits on long lead time items. So, the way it works is that you need to spend the equity first before the debt. So, we have enormous 930 million in the treasury in cash and cash equivalents. And so we will commence construction once we receive final federal approval for the project.
Okay.
Now, when that is, I'm respecting the CNSC's process and their determination of that. But I said earlier, we are extremely confident that that process is nearing conclusion.
The 40 months that you're giving me here, I've never built a mine myself, unfortunately. So I don't know if that's too positive or not. What is it based on? Is this a positive estimate? Do you have a range where you could say it's either 40 or 50 or 40? Like, is this?
Oh, that's based on the feasibility study, which incorporates a schedule from mining engineering companies that have said this is, that is the time it is going to take with respect to construction. We know sinking of the shafts is around 2.3 meters per day when drilling. So that's not that estimate is based on very sound technical and engineering principles.
Okay. Well, and all that you're telling me here, it kind of sounds like you're just very determined on bringing this into production yourself. But do you think there's a reasonable probability that you get taken out within that 3.5 years, or are you operating under the assumption that you will be taken out? How do you look at this?
No, we've approached every day on the basis that every decision we've made is on the basis that we'll take it into construction, production, and then close the project at the end of the mine life. And I think that's reflected in the fact that we've incorporated underground tailings management into the project. That is ensuring that us as owners and closing the mine have done an incredible job right throughout with proactive ongoing reclamation and not leaving a huge liability at the end of the life of the project. Now, there's no doubt having such a high profile asset, one which will take us into the top 10 mining companies worldwide based on after-tax net cash flow, the fact that we're in a premier sovereign jurisdiction worldwide and sovereign risk is now very high on the aspects of all the fund managers. We are in the best sovereign location achievable. We have an outstanding community focus. There's going to be attention. A lot of companies are going to want that type of asset in their portfolio. You've heard the majors talk about transitioning to having a higher weighting of clean energy metals in their portfolio. Ours meets economic performance undoubtedly. Environmental performance, undoubtedly, and social performance, undoubtedly. And the other aspect is the nuclear fuel that we'll be producing takes off the equivalent of 70 million vehicles of CO2 equivalent every year. Now, that is incredibly powerful on all the key metrics as to why someone would like to invest or own our asset. So naturally, yes, I believe the interest level, once we receive federal permit, will increase. But any decision around that as to whether we're taking the production or someone else has to be in the best interest of shareholders. And so any possibility on that front has to be very clearly in the interest of shareholders. And I think as we speak, we are totally levered to future uranium prices. We've demonstrated that everything we've done today has set new standards in the sector. Construction and operation will be no different. And so, yeah, I think we are the best team to take it into production. I've assembled the best of the best minds around the world for this project. And so, you know, unless someone comes along with a price that knocks us off our feet and is better than we can do ourselves, we'll be the ones taking it forward indefinitely.
If we had spoken in 2015, a price that knocks you off your feet would have been $1 billion. Stock is trading now at a $6 billion market cap. What's that price today? Is it 12? Is it 60? I mean, what gets you excited?
Well, I look at, you know, the market caps of those mining companies that produce $1.5 billion US in after-tax cash flow annually. I think the last one has a market valuation of around 30 billion US and the highest 74 billion US. We're currently at 6. So, you know, and that's with a uranium price staying constant at $90 a pound. People invested in uranium or interested in uranium, you know, let's look at some of the Twitter feeds. They think it's going, you know, through $150 to $300 a pound US. Even at the current price, we're in the top 10 world mining companies with market caps between, you know, 30 and 70 billion. So that's what I look at. And any decision on that needs to have a relative comparable. And so I think that's the one most people will look at if that type of alternative arises.
There's also something that I recently started paying attention to, are change of control fees. They are present here as well as they are in most companies, and they're purely theoretical, as in you get taken out, management gets a payout as well. Does the value of the change of control fees for you surpass what you've personally invested in this company?
No, nowhere near it. My equity in this company, as we speak, is 57 times my cash salary. So that speaks for itself. I'm equity incentivized along with all other shareholders. You know, income-wise, that's not important. But those who know me well know that you know, I judge myself on getting the optimal outcome for all. And that's been clearly demonstrated in the 13 years of having founded the company and the way it's conducted itself. And that's not changing. So am I equity incentivized? Absolutely I am. Absolutely I should be. And you know, I've bought all of those shares myself as well. So yeah, again, all the information's there, very transparently. It's audited. Anyone who looks at it objectively will see that this is a fantastic story and is being approached and executed in an elite manner relative to anyone else in the sector.
When I look at change of control fees, I'm also thinking, sometimes I'm thinking like, okay, management should be incentivized to sell this just as soon as possible at whatever price. Not for you specifically, happens with other companies. But that just, it hasn't happened yet for you. And I wonder, I wonder why. I mean, those conversations, and I can only speculate, of course, but I must assume that those conversations have taken place. Like you've spoken to people at the large mining companies, they have or have not expressed interest, but why isn't Arrow sold yet? I guess is what I'm asking.
Well, I think one of the, and look, without breaching any confidentialities, yeah, discussions have always happen. That's part of the business, and it's my job to always explore the best avenues for shareholders, be it us taking in production or sell it at a price better than we can do ourselves. Why hasn't it happened today? Well, I think that's reflective of getting a permit to construct and operate a mine is heavily involved. There's a lot of uncertainties, and that's no different for us. That's consistent with every mining project. We happen to be at the very back end of that process. To maybe answer the question a different way, people ask me, what do you see as the biggest risk? When we're in production, I look back, the biggest risk was always going to be around the permitting. Now, we're almost at the final stages of concluding that and putting that in the bank. And I think that anyone who's interested in the company, and look, I have many discussions with fund managers and companies. There's a lot out there who are saying, once you have the federal permit, we're in. Now, that's from a fund management perspective. I'm sure there's mining companies out there that have the same view. Once that federal approval is in place, I think, as I said earlier, the attention on the company will increase. But whether that results in a decision for us to sell it or take it forward ourselves remains to be seen in light of those other aspects which I discussed earlier.
I just want to note that I just had a glance at the clock, and I really appreciate you putting all this time. I still have questions to go, and I hope I'm not boring you or putting you to sleep at this point.
Not at all.
But you to sort of keep it going here, then in this case, I understand the timeline, and then I understand how you want to go into production. The production profile is also interesting, though, as in I believe you've under the current mine plan, you've chosen to go for 29 million pounds per year. That's obviously very aggressive. It's a lot. It's going to put you right up there with the top producers of uranium. What was the decision process behind this? And let me maybe explain where I'm coming from with it as well. But so, wouldn't it make more sense for you to start it smaller, not small, because whatever you do is just not going to be small, but smaller, and have an easier time permitting and a lower capex, quicker to build it out, and so on and so forth, and also maybe have it easier to sign delivery contracts and then pay back that capex that way. So, what's the decision process behind that 29 million pounds?
Yeah, really good question. And our approach was, we looked at the ore body, we got production geologists to assess what is the optimal mine plan for the project. And that number resulted in 30 million pounds per annum. It wasn't us saying, okay, this must be 30 million pounds, now go and design a mine that does that. We gave the platform to the production geologists to go and determine what is the best mine plan, and it resulted in 30 million pounds per annum. That is what the project's capable of doing. Whether we produce that or not, we will produce in light of the market conditions at the time. And we're not just going to produce for the sake of producing pounds or producing 30 million pounds. We have the perspective of optimizing the return on every pound produced. Now, do I think the project will be at 30 million pounds when we're in production? Absolutely, I do. The gap between demand and supply needs 3 arrows by the end of 2030. Now, there's only one that exists. Even if one was discovered today at our Patterson Corridor East prospect and turned into another arrow, well, looking at Arrow itself that we discovered in 2014, we're in 2024 today. On the basis we would receive the approval this year in the next 6 months, it's still going to be another 40 months or 4 years until we're in, that's 2028, 14 years from discovery through to production. If we were to find one today, that's 2038. Now, I believe the market demand and supply, which is again out there for everyone to see, there is an enormous gap. And when you consider that 44% of the world's production is coming from Russia or Russian influenced countries and the status around that sovereign risk, the world needs not just one arrow, it needs multiple arrows. And so I thoroughly believe the latter part of this decade will be producing at 30 million pounds per annum as a consequence of the current market demand and supply situation, which is, demand's never been more assured, supply has never been more fragile, and there's just not enough actionable uranium projects as we speak.
But you do think you're going to be able to place a good deal of those 29 million pounds within contract and then keep some exposure to the spot market, I assume. What's that split, by the way? Like, what are you thinking?
Well, we won't have a fixed split. We'll be making decisions around our contracting strategy in light of market conditions at the time. So our principle, though, is to keep exposed to the prevailing market prices at the time of delivery, as opposed to locking in fixed prices 5 years before. So that's our philosophy. We have the technical and also low operating costs in order to leverage having exposure to future prices. So, we have a natural flaw, being we have, the feasibility study all in showed $10 US a pound costs. We have a natural flaw because the current producers have cost structures where they're not making money at $90 a pound. So we're not seeking floor-based contracts, and we're not seeking a ceiling either. We want exposure to the market price at the time we deliver it, and that's our strategy. We're getting very strong traction for it. In terms of offtake negotiations, they will evolve over time, not just this year, but continually evolve as we lead into production and then establish steady state production. What's important to shareholders? Leverage to future uranium prices at the time of delivery.
Is it? Yes, I tend to agree, but then I also am reminded of you just recently buying pounds of uranium, which is kind of me thinking about, was this a strategic move? Was it really about the pounds, or was it about something else? Because if I wanted to get exposure to those pounds, I'd just buy spot, right? So why not? So it's basically comes down to, why did you buy those pounds? Was it strategic, and is it relating to what you just told me?
Yeah, it's totally strategic and in line with negotiating contracts for delivery 2028 and beyond. You've highlighted there's timing risk around taking a mine into production. Utilities, I'd say their anxiety around their security of supply in those years, and that's where contracting is today. We're talking about contracts commencing in 2028, 2029 and beyond. That's where the negotiations are today. Having a number of pounds on hand to help mitigate construction and startup timing is sensible. It shows the utilities that we have their back, and a mitigating factor in place if there is a delay in commissioning. And so the strategy behind that purchase is about optimizing every pound we produce, whilst recognizing that sensitivity for utilities and mitigating it. So it's a function, I think, of starting a uranium mine. These utilities rely on the delivery of the nuclear fuel many years out, and if they're caught short, they can't go back in time in order to re-procure. So it's really a function of the nature of the fuel, the importance of it to the utilities, and it's consistent with what a lot of other startup uranium companies have done. Boss Energy, Denison, UEC have all done the same, and it's purely a function of a startup in a uranium mine, ensuring that you're meeting the utilities' interests.
But this strategic move, when did the decision for it come? As in, like, because you're buying this, it's not cheap anymore. It's not $20. It's at a point where uranium could go up, but as Rick likes saying, it no longer has to go up like it was when it was at $20. Uranium absolutely had to go up. So if you had those plans to go into production when uranium was 20 or 30 or $50, why didn't you buy some or all of it then?
Well, we're not driven by the speculating in the uranium price. We're very process orientated. We're negotiating those contracts now. The timing is now. Now, we personally believe that the price of uranium is going far higher. I was in the industry back in 2008 when it went to $136 a pound. In today's terms, that's $205 US a pound. The decision to acquire pounds today is in line with our stage of development and our stage of contracting negotiations with the utilities. And it's a very small amount, 2.7 million pounds against a production profile of 30 million pounds per annum. Now, we paid $1.35 below the spot price the night before for those pounds. If we'd gone into the open market, purchasing 2.7 million pounds probably would have pushed the price beyond $120 US a pound. So we bought very, very well. We issued a convertible note in consideration for those pounds that was at a 30% premium to the company's share price on the day. And so we bought well, and the consideration that we gave in satisfaction of that purchase makes, financial sense. It speaks for itself.
Yes. Maybe the interest rate of it all kind of messes with my head here. Where it's a debt offering. And as we've been talking throughout this conversation, you're not a cash flow generating company yet. Is that being taken into consideration as well? Because also the party you're signing this guy, and why I'm asking that, I'm sorry for continuing on, but why I'm asking that is because the party you're signing this with is also who might have a potential conflict of interest because they're connected with you in a different way, as far as I understand it. So talk to me about that.
I'm not sure what you mean by that. It's entirely at arm's length who we transacted with, MMCap. They saw more leverage holding NexGen equity than they did holding the physical. With respect to the
but their
interest rate,
ownership in the company did increase before closing that contract. I think that's what I mean.
Sorry?
Did their ownership in the company increase before signing that contract? Like, did they buy more shares before you actually went into this contract?
They have shares. They had owned shares in NexGen prior to signing this contract, and they've increased their shareholding through this convertible note that we've issued in satisfaction. Now, with that convertible note, it comes with voting alignment. And then also restrictions on trading the company's equity. So it's an instrument that we first introduced back in 2016 with Li Ka-shing. We've done it twice with Li Ka-shing, twice with Queen's Road Capital, and Sol Patterson's in Australia as well. And so it's an instrument we're very familiar with, and it's been successful every time we've employed it. Now, you mentioned earlier the interest rate gives you some heartburn. Now, you're investing in NexGen. You're obviously investing in us because you see that we've got tremendous leverage to the future price of uranium. The price of the uranium only has to go up $5 a pound every 52 weeks for that to mitigate completely the coupon rate on that instrument. And as I mentioned earlier, that instrument was priced at a 30% premium to the share price at the time we executed the deal. So there's the financial facts. As you alluded to, people on Twitter, social media have drawn conclusions that it's abrasive, it makes no sense. Well, I'm here presenting the facts, and people will make their own determination. I just encourage people to make the determinations based on the facts, not assertions from anonymous social media platforms that have misinterpreted.
Yeah. Again, and I appreciate you answering these questions, trying to wrap my head around it as well. And we are still, by the way, talking about timelines. If people are not no longer paying attention or whatever. And this is actually the final timeline question here, I suppose, which is when do you actually go and actively sign those contracts? You told me you're in talks with utilities and whatnot, but there's nothing. We haven't seen anything official yet. Should have we seen it already? Would that help you finance? Would that help you with permitting? Talk to me about that.
Well, the uranium purchase also helps with the debt negotiations because it mitigates it for the debt holder as well. So, you know, the strategy behind that purchase was multifaceted. With respect to signing the offtake arrangements, as I said, it's going to coincide with federal permitting. Now, we may sign some prior to the federal permitting coming in, and that would reflect the utility's confidence in our timeline to production and their understanding of the federal permitting process. All I can say is it's imminent. We're running a number of streams in parallel, which reflects our confidence around the permitting, around the financing, and the sales offtake negotiations and signing of those contracts is a consequence of those facets. So that is our approach, and I think well, it's not. Not that I think it is a very logical approach in light of all the facets that influence that outcome.
What do you think about the timeline of those contracts themselves? Like, would you be looking to sign? I mean, would it even be possible to sign 10-year contracts, or are you looking for 3 to 5 year contracts?
We are negotiating 3-year contracts because this market's changing really quickly. We are entering in with this Russian uranium ban. We are entering into an unprecedented era in this market. Demand has never been more assured. Supply has never been more fragile. And the use of nuclear energy as a core baseload component of economy's energy mix is absolutely crucial. So we aren't locking into 5, 7-year, 10-year contracts. That would be insane to do that in such a changing environment. And while some have criticised our approach about not locking into such long-dated contracts, we've proven to be correct in keeping exposure to market-related prices at the time of delivery. And as this situation keeps evolving, which it is evolving on a daily basis, terms are going to improve. And until we have the timeline subject to the federal permit to then say, right, this is the timeline we're going to be hitting production, it's not logical for us to enter into size and volume over many, many years until we've got a good understanding of when we're in production, but also who can predict what's going to be the situation in 5 to 7 years from now, except to say, I think the fragility around world supply, particularly in the Western world, is going to be enormous. And having an asset that is technically competent, highly economic, and has flexibility to ramp production up, ramp production down in light of market conditions is the right way and the right approach to go. And look, our shareholders also say and are supporting it. So look, that is different to some of the other producers, but we are executing a strategy that is relevant to how we see the environment and the way our asset fits in that environment. And as I said, it's getting enormous traction, not just with utilities, but with also fund managers as well.
Lee, you've been here 1.5 hours, actually, almost exactly to the minute. So I do want to work towards letting you go and closing the conversation. Maybe just sort of kind of tie it up here. Everything that you're telling me here, would it change materially if the new discovery works out in the way that you hope it does?
Well, look, a very good question. There's absolutely, we've incorporated some design components into the feasibility study and the final engineering with the view that there's additional deposits in the area. it's very, very clear there's additional mineralization in the area. We also have mineralization below the arrow grade shells. We've hit mineralization in 3 holes below the grade shell that are 500 meters apart. So there's no doubt that we have planned for additional mineralization in the area to come through our project. That would obviously, a new discovery would be subject to a separate permitting process, but our current mine life, excluding the inferred resource, which will become indicated and part of the mine life, is currently 11 years. We're going to have a huge lead time on that permitting, and that permitting has been done on the basis of an area of influence as well. So, and the design of Rook 1 has been done on that basis as well. So I would say an additional discovery will, as we currently speak, has the ability to extend mine life at this stage at 30 million pounds per annum.
I appreciate you being political about this. When you say additional mineralization in the area, it doesn't necessarily have to be your mineralization, I suppose is what you're saying here, as in, would you be interested in working with some of the companies that already have established deposits?
Well, I would say it's both. We clearly have additional mineralization on our tenement. I mentioned earlier there's triple R 7 kilometers from the Arrow deposit. I think it makes, from my perspective, the most sense technically, environmentally, socially, that you have 1 mill in the area. So we have purposely designed it that in the event those deposits are developed, that it provides the avenue for us to service other mineralization in the area. And look, we've been very transparent about that all along. So whilst that is to be determined, and we have a core project at Rook 1, which will have an enormous, we're permitting for a 24-year mine life based on just what we know today, irrespective of any additional discoveries or nearby deposits. It's a great platform to launch off.
Is there the willingness somewhere in that process to go and try and do M&A in the space yourself, not being the target of it, but be the perpetrator, if you will?
Well, we've always had we always have a focus around M&A. We developed ISO Energy that has exposure to assets in the eastern side of the basin, but also in the US and Australia, where we see value in the uranium space. So we are active on the M&A front, and it's through the ISO vehicle. With respect to Arrow, well, you've got to consider it in light of, is it value accretive to the Arrow Rook 1 project? And so I would say the field is extremely limited from that perspective, but we're always looking at it and considering it on both angles, acquisition, but also, financing the Arrow project in the most optimal manner. So we do quite a bit of M&A, and frankly, that's a large component of our administrative cost is one-off corporate development analysis.
All right, Lee. Well, as I was about to say, we've been through pretty much everything. I mean, from exploration, development, permitting, into construction, even contracting, all these things. What am I forgetting to ask you, though? What did you come here hoping to talk about that I'm failing to bring up?
No, I really appreciate the opportunity to, in some part, for those who may have been ill-informed, to present the facts. And again, I reiterate, all those facts are available on our website. All of our statements are audited. We're very transparent with respect to our approach, our performance, and the consequences of those two functions. And we're very excited about the stage of the company's development, in that we're on the cusp of taking it into construction. Obviously, again, being very respectful of the concluding the final processes with the CNSC. It's an exciting time at NexGen. We have an incredibly dedicated team working on a phenomenal asset and doing it in a manner which is delivering new standards for the sector. And we are judging ourselves on how we optimize this outcome. And to date and going forward, that's been incredibly rewarding for shareholders, and we're very proud of our shareholder base. We exhibit all the top fund managers in the space, and also generalist fund managers on our register. And so for those who may not be as familiar with the detail, have a look at who's investing in the company in size. And if you gain comfort from the fact that those companies do extensive DD, well, I'm sure you'd be able to get a good gauge as to the merits of investing in NexGen.
I'm actually reminded of one last point. I promise it's going to be the last point.
Yeah,
Do you have a couple of shareholders, though, that were not happy with the purchase of uranium, or a couple of the other things that are happening and have been vocal about it? I suppose it's fair to name them as well as we're talking about them, but Warren Irwin, for example, is a fund manager out of Toronto, Canada. And Li Ka-shing as well. You mentioned him a couple of times. I don't think they've been as happy with some of the things that have been happening. What do you say to them and what they've been saying?
Well, I understand through Warren himself that he sold NexGen well below $6. So I'm not aware that he's actually a current shareholder, or has been since we passed through the $6 mark. With respect to Li Ka-shing, he's been an investor since 2016. I think his return on NexGen's around 700%. But with respect to that uranium purchase, on that day or the night before, we had hit a new all-time high market valuation. And that was his trigger to dispose of his remaining 4.5 million shares, which he did on that day. And so I think the market's reaction to our purchase of uranium was somewhat skewed by an unrelated disposal of our shareholding by Li Ka-shing, who had made 700% returns since 2016. And for the interest of shareholders, we'd been dealing with his 18% shareholding since September of last year. And we've orchestrated that changeover of his ownership with new investors with a much higher cost base, averaging around $10 Canadian, and in the process raising $500 million. And the night prior to our announcement of that uranium purchase, we're at an all-time high and leading the charts against all of our peers in terms of share price performance. So that was a sensible move by Li Ka-shing. He'd been in it since 2016, made 700% his money. And we were aware of his intentions to dispose, but I think the market maybe took that disposal as disapproval for the uranium purchase. But I also got a lot of support from our major shareholders who are very close to me and understand my approach and that of the board's approach and the team's approach, who thought it was extraordinary that we were able to get our hands on that quantity of pounds at $1.35 US below the current spot price, and to pay a 30% premium on top of our share price for that. That financially, that's completely fact-based, makes enormous sense. So, with respect to, you mentioned Warren Irwin, I'm not even sure why he would be commenting when he has no vested interest.
I suppose opinions are a dime a dozen, and especially.
Look, I think Warren's a great guy. He was very successful with his investment in NexGen, and I enjoy his company. But again, I can only present the facts as I have today, and those facts really speak for themselves. And look, in terms of my interest in NexGen, 99.9% of my wealth is held in stock of NexGen. I'm doing transactions which I see is growing that, not impairing that. And so there is incredible motivation by me to see this company not just like go into tomorrow, but go an enormous way towards becoming a top 10 mining company, of which the federal permit is a significant value gate, which we believe we're in the final stages of attaining.
That's it, Lee. I'm going to shut up now, because if I don't, I'm never going to shut up. But I greatly appreciate you investing so much time in me. And yeah, thank you for doing this.